If the Fed keeps high for longer, then we will see that slowly wind its way through the economy.
As long as the market still believes they're about to embark on a series of rate cuts, then equities can hold in.
We will continue to see upward inflation pressure and potentially upward pressure on rates.
You still need to see this softness come through, and we're not seeing it across any of the metrics.
The longer the Fed holds at 5 and change, the risk in the equity market is actually increasing rather than going down.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from the nation's capital for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro, kicking off our coverage of the IMF World Bank spring meetings. And I have to say, the two big issues in the global economy right now, the two big issues are right here in Washington, D.C. The sustainability of the deficit in the United States of America and this drift towards industrial policy. Front and center, Bramo. Every single conversation you have right now, all roads lead back to that.
Especially given the fact that it seems to be sovereign debt that's going to be the real issue, not necessarily any kind of corporate debt. When you talk about the geopolitics of the moment and the fissures between China and the U.S., it'll be fascinating to see at the IMF how that's dealt with, given the fact that China is a member of the IMF and supposedly is trying to create a global coalition. What does a global coalition look like in a fractured world?
So it's not just China and the United States. It's the United States and Japan. It's the United States and South Korea. It's the United States and India, Malaysia. You see this repeatedly in the FX market. The rupee at all-time lows. Malaysia stepping into the FX market. Japan, South Korea threatening to do the same. And what you saw take place yesterday, Annmarie, I thought was really interesting. A meeting between Secretary Yellen, the Japanese and South Korea. Foreign exchange is going to become a big issue through the next couple of days.
Absolutely. And they put out this joint statement after this trilateral meeting. And this was the quote. We will also continue to consult closely on foreign exchange market developments in line with our existing G20 commitments. It goes on to say, while acknowledging serious concerns of Japan and the Republic of Korea, it's almost an implication that the United States is aware of what Japan is dealing with and that they're okay if they're going to prepare to intervene to try to prop up their currency. Because what you started the show with is this loose fiscal policy. What does that mean in terms of a higher dollar?
Okay.
The rest of the world is dealing with U.S. exceptionalism.
But what could they do, right? I mean, this is essentially the policy response that is really uncertain. You have the finance minister, the currency head over at the Bank of Japan saying we're concerned that this could have a bad effect on our economy. You have Janet Yellen saying we acknowledge the worry. What are they going to do if it's just differentials in growth? And this is a factor of differentials in monetary policy that is not changing.
So the answer is nothing. So the next question has to be, for how much longer can they take it?
Yeah.
For how much longer can this go on? Because ultimately what they all want are rate cuts from the Federal Reserve. It's not just the market, the equity market and Wall Street that wants to see rate cuts from the Federal Reserve. It's the global economy and a lot of policymakers worldwide who would like to see the same thing.
Which raises this question, how much is that going to really factor into the Fed's decision making? And what happens, and this is something we were talking about yesterday, what happens if they cannot cut rates because inflation remains too high and they're going to be accused of political interference? Then do all of a sudden we see the dollar breaking things? And are we getting closer to that point?
And what you're hearing from a lot of people alongside the IMF is they need to know what is going to happen post-election. Because one thing the IMF talked about is the fact that we already have this loose fiscal policy in the United States, but they say it's even looser. They like to spend more in election years. So that means potentially the hangover after November is going to be even harder for the rest of the world.
What's it feel like to come home? Does it feel good?
Feels hot.
Have you missed Washington, D.C.? It's hotter.
It's warm in D.C.
Swampy. Let's turn to the price action. Equity futures right now on the S&P 500 shaping up as follows. On the S&P, a little bit of a bounce. We're up by about 9 points on the S&P 500. We're positive by 0.2%. Yields are lower by a single basis point, 457.31 on a US 10-year. And crude pulling back by 1%. We're back down to 81.82, Bramo. And I think if you were worried about a stronger dollar, you've had a weaker one. If you were worried about higher crude prices, they're lower. And if you're worried about higher yields as well, they've pulled back too in the last day or so.
It's a tense pause. Honestly, I can't get a lot of signal from this. We did get a 20-year auction that was better than expected yesterday in terms of how it was received. But right now, very difficult to say that there is a calm or any kind of feeling of complacency, particularly around oil. And there's a big discussion around that here at the IMF meetings. What happens if you do get a surge in prices? And you can't plan ahead for something that hasn't happened yet. And that's essentially what the market's kind of reeling around.
We'll have that discussion in just a moment. Coming up on the program, we'll catch up with Tony Dwyer of Canaccord Genuity. volatility with stocks on their worst losing streak since January. Leland Miller of China Beige Book as President Biden ramps up tensions on the campaign trail, and Tiffany Wilding of PIMCO on worries the path to 2% is starting to stall. We begin with our top story. The S&P 500 looking for its first gain in 5 days as Treasury yields continue to ease. Tony Dwyer of Canaccord Genuity saying this: we expect both the interest backdrop and EPS contribution to improve later this year, following a period of market indigestion that should relieve the historic overbought condition. Tony joins us now for more. Tony, can we talk about market indigestion? When you say market indigestion, is that a 5% move lower, a 10% move lower? What is it?
Well, John, it really depends on what you're looking at. So to me, we so focus on the S&P 500. And as you know, I stopped giving a target a while ago because I don't know how to evaluate 10 stocks, which now make up 34% of it. So could the S&P 500 go down between 5 and 10%? It could. The equal weighted S&P 500 and the Russell 2000 and the average stocks, you know, the troops versus the generals, they've already seen some pretty poor relative performance. They're actually at a cycle relative performance low, where a lot of damage has been done. So I don't think you're going to get as much pullback in the broader market, because you've already seen it, than you could in the S&P 500.
So what are you advocating for right now, Tony, given everything you've just said?
So what I missed last year, and I think what a lot of people missed, is if you remove the Magnificent Seven stocks from the S&P 500 operating earnings, according to LSEG, my earnings wizard there, TJ Dillon, you would have had a negative earnings year ex the Mag 7 for the S&P 500 operating earnings. The same is true for this quarter. So it's no surprise that you got the market concentration that you got because you had a concentration in earnings. What I'm talking about is the market indigestion is doing exactly what it's doing now. You pull back, you create fear, the S&P targets come down, people start calling for a correction, the bull-bear ratios get out of whack and get back to more normal. The overbought condition is relieved, and it sets the stage for later in the year. The higher rates are now, guys, the more likely they're going to be lower later this year, because it's going to have a dampening effect on the economy. If the lower rates and or the talking of lower rates and looser financial conditions got us into the reacceleration, won't the opposite happen, given how talking of not lower rates has tightened financial conditions? And I think that and a better earnings contribution really sets a stage for a recovery in the second half.
It's getting harder and harder, Tony, to see what happens past June. I am curious, though, what happens if the Federal Reserve cannot cut rates in June, as pretty much is consensus right now, and the ECB does cut, and the rest of the world does cut, and you start to see the dollar getting stronger and stronger. Are you worried about something breaking and this becoming less orderly than the immaculate disinflation we were talking about earlier this year?
Yeah, Lisa, I am worried about it. How can you not worry about it? You're in a levered system. You know, we have a generationally levered system when you look at debt to GDP. Every area of the universe in finance needs lower rates right now, whether it's M&A, whether it's Wall Street with capital markets, whether it's the federal government who's got to raise debt at much higher short-term rates than they have in the past. So it's a very tumultuous time. And at least that's what's showing up here. That's why the dollar is rallying. That's why the bond yields are starting to drop when you have market indigestion. You're in this situation where nobody would think about Jerome Powell at the end of the dovish pivot at the end of December last year. You know, the market's looking for 7 rate cuts. Now he's saying maybe none. So we're looking at somebody that keeps telling us information that changes it within 3 months aggressively. So to make the assumption we know what Jerome Powell and the Fed is going to do 3 months from now, I don't think makes a lot of sense. What makes a lot of sense to me is financial conditions are tightening as rates have gone up. The financial markets are pulling back. That sets the stage for, again, that lower rate Fed rate cut environment later in the year. And that kick starts it once we get through this indigestion.
How much is this Federal Reserve leading and not following more than people realize? How much did they actually cause the stickiness of the inflation by the initial pivot late last year? And right now, the repivoting back to a tighter kind of monetary policy is what's causing the indigestion that might allow them to cut rates. Is that what we're looking at? That essentially they're going on a dovish tact at the end of last year was a policy error that allowed inflation to run hotter than a lot of people thought?
Lisa, they've got it right once. by tightening like they have without creating a recession. That was 1995. So the immaculate 1995 scenario is what everyone is hoping for. But the Fed is managing monetary policy by talking versus acting. They haven't changed anything. So if you're raising money at the federal government level by short-term T-bills, you're still doing it at over 5%. Money markets are still over 5%. So until they actually change and I'll leave you with this main thought. What could possibly lead to a broader market recovery versus the historically concentrated market we've had? Two things. Number one, you have to have the Fed actually cut rates. Until then, we've seen it very clearly this year in the behavior. Now with the Russell 2000 down on the year, you need rate cuts to broaden out the market. That's the indigestion. Number two, you need a broader distribution of earnings contribution. You can't have 7 stocks contributing all of the growth on a year-over-year basis. The good news is both of those are set up for as we exit the year. In the fourth quarter, it's going to be a much more even earnings contribution. And with the way that the Fed is talking about rates now, creating a tighter financial conditions, that's going to end up leading to even lower rates as we end the year.
Tony, we touched on it at the top of the show, but we'd love to get your thoughts on where you see oil prices going, in the sense that how difficult is it going to be for the ECB and the Fed to combat?
Annmarie, it's a really hard call because it's a commodity call that's under momentum. So now, just as everybody's talking about energy and higher oil prices, you've seen now some estimates come out, could go to over $100 a barrel. Now it's starting to drop. Remember, ultimately, energy goes to supply and demand. The currency situation that we have is because there's no growth. The problem globally is you need growth. You need demand to pick up. So I am not a commodity analyst, and I don't want to pretend to be. What I do suggest is when everybody starts to get excited about and trade the momentum of a commodity, it typically tends to reverse, especially if the supply and demand dynamics kind of reinforce that, which I think they do. Higher rates are not great for economic activity, and that's showing up in currencies, and it should start to show up in some of the commodities.
Hey, Tony, wonderful to catch up with you, sir, to get your thoughts. Tony Dwyer there of Canaccord Genuity, always humble about what he doesn't know. And there's a lot we don't know right now. If basically a key part of the year ahead is what happens to the price of crude, what do we always say about the price of crude? If you want to make a fool of someone, ask them for their forecast on a price of crude by the end of the year. It's tremendously difficult to do. And we're sitting here saying that's going to be a big feature of a whole set of decisions that are going to be made this year, including from the ECB and how many rate cuts they deliver in 2024.
Especially when so much is really determined by something else that you cannot predict, which is a crisis in the Middle East. Since when have you been able to predict how this is going to transpire? And yet, if there is some sort of protracted conflict, which is very much on the table for a lot of strategists, you could get the closure of the Straits of Hormuz, which leads to oil supplies getting curtailed, and that could lead to a real pop in oil prices.
And I like what you said, Lisa, earlier about how this is a pause, because it's the geopolitical risk premium that we saw everyone buying into when things were heightened, now starting to come off the table. But what happens when that's back on the table? And also overnight, you have the United States deciding with Venezuela they're not going to extend some of these contracts. It's not affecting physical supply right now, but you can see certain corners of the world where supply might be hit and how difficult that's going to be if you have a crisis on top of it.
Crude right now down 1%, 81.79. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Let's catch up with Danny Berger. Hey, Danny.
Hey, John. Taiwan semiconductor manufacturing had better than expected revenue outlook and is sticking with its plans to spend as much as $32 billion this year. So that upbeat outlook, it also follows the chip maker's first profit increase in a year. Strong AI demand, no surprise there, boosting TSMC's growth. It also comes at a time for a chip correction for many stocks, so maybe this is the thing needed to turn around sentiment. UBS planning another round of layoffs. The cuts this time coming as the bank is looking to trim headcount as part of its integration with Credit Suisse, an ongoing story. It's more than 100 positions across banking, markets, and wealth management will be cut, according to people familiar. Doha's Hamad International has been named world's best airport. It edged out 12-time winner Singapore's airport in the Skytrack World Airport Awards. But, do they even have a waterfall? Asia had a strong showing in the top 5. Seoul and Tokyo's twin facilities took the 4th and 5th spots. Hong Kong's airport saw a significant boost, moving up 22 places to 11th place. That's your brief, John.
Danny, thank you. Still waiting for JFK to break it into the top 5. When's that going to happen?
All I can say is LaGuardia is actually beautiful, and I never thought that I would say that.
Beautiful is not a word I would use for that airport, but
okay,
it's better.
Come on. There's some beautiful.
Do not hold your breath,
Come on.
John.
I mean, have you seen the
Beautiful?
waterfall that goes?
Sure.
No, that is not
Beautiful
a
is not a word I would go to.
Well, you should.
That is not a real
It's
waterfall if you ask anyone in the Doha airport.
Is that what it takes to satisfy you at an airport?
Yes.
Just water falling
Correct.
down? Okay.
Except that like goes to music. Okay, thanks.
Up next on the programme, Speaker Johnson's Moment of Truth.
I have a job to do here, and I'm going to do the job. And regardless of personal consequences, that's what we're supposed to do. If Marjorie brings the motion, she brings the motion, and we'll let the chips fall where they may.
That's coming up next, live from Washington, D.C. This is Bloomberg. Four days of losses on the S&P 500, the longest stretch since early January. I've said a few times over the last few months, we've been absolutely spoiled in this equity market, and I think that's an example of that. 4 days, Bramo, longest losing streak in a few months. That's how good this market's been.
So it raises this question, is it a buyable dip? We've had basically a 4.4% drawdown in the S&P from some of the recent highs, which is the biggest that we've seen since the October beginning of this rally. And the question is, okay, does this open up the path for all the people who said they were going to buy the dip? Is this a dip?
5 minutes ago, 5,500 didn't sound like a punchy price target. All of a sudden, it's back in play. Feels like serious upside.
Yeah, well, especially, yes, which is kind of funny, and it shows how quickly Wall Street was moving. But it also shows the uncertainty right now with respect to, is this the new normal with respect to the yield space, and what's going to happen next? That's what we say, it's a pause. We're kind of in this uncertain tipping point in terms of rhetoric and narratives.
Equities firmer by 0.1%, yields just a little bit lower. Under surveillance this morning, Speaker Johnson's Moment of Truth.
It is different than the Senate's bill. For the Ukraine piece, for example, we've introduced the loan concept. So any funding that goes to support the government of Ukraine is converted to a loan. We have a lot of new changes in here. We have accountability and a strategy shift as well. I have a job to do here, and I'm going to do the job. And regardless of personal consequences, that's what we're supposed to do. If Marjorie brings the motion, she brings the motion, and we'll let the chips fall where they may.
Here's the latest this morning. House Speaker Mike Johnson pushing ahead with a $95 billion foreign aid package for Israel and Ukraine. Johnson planning a series of votes on Saturday, despite at least 2 House Republicans threatening to oust him. Ed Mills of Raymond James writing this. The wild card is if House Republicans stick together and add on border provisions that are poisoned for Democrats in both the House and Senate. Speaker Johnson has been dealt a tough hand, but he has a path. Ed Mills joins us now. Ed, good morning to you.
Morning, John.
How narrow is that path?
I think it's actually okay. Speaker Johnson yesterday came out and for the first time really called for Ukraine aid. What is going to be on the floor this weekend is essentially what passed the Senate a couple months ago, but they're going to have individual votes. So we're going to vote separately on Israel, Ukraine, Taiwan. There's going to be a fourth bill that is on TikTok and a bunch of other Russia-related provisions. And then there's going to be a border security bill. I think the border security bill falls off, but those other 4 bills come together, move over to the Senate, and when the Senate comes back on May 1st, this gets sent to the president. It gets signed into law early May.
We saw UK Foreign Secretary David Cameron go to Mar-a-Lago. Now we see former President Donald Trump sitting down with Andrzej Duda of Poland. How much is the international community having to put pressure on the former president for him then to say yes or no to some of these hard right members of whether or not they can vote for some of these packages?
So, Annmarie, I think those meetings are just good due diligence, that there is a very high probability that Donald Trump could be president again next year. And so if you are a foreign leader here in the United States and you have an opportunity to meet with the future president, you have that. I think as it relates to these defense bills, his influence has been shown in the fact that the House has not passed these bills yet. But now that we have had the attacks directly from Iran against Israel, the pressure really is there for Congress to act. And Congress is going to essentially pass what the Senate did months ago, send it to Biden's desk with a couple of additional provisions.
Given these are all separated out and we have different individual bills, when they go to the Senate, they potentially could be one package. And in that sense, I'd love to ask you about TikTok. Does that mean TikTok has a chance to actually make it through?
TikTok's the time is numbered here because this bill, Senator Cantwell, who is the chair in the Senate on the Senate Commerce Committee, has come out and endorsed the provision that has been added to the House bill. This House bill is going to pass. It overwhelmingly passed previously. And so those 4 bills are going to be combined. Those 4 bills are going to pass the Senate. And sometime next year, TikTok is going to either have to divest its Chinese ownership or shut down here in the United States. My bet is probably shut down because I am not quite sure that the Chinese Communist Party is going to allow that divestment to take place and that algorithm coming over to the United States, and for us to truly understand what TikTok is collecting and how TikTok is influencing a lot of the kind of conversation here in the United States. The reason we're passing it is real national security concerns. China's not going to want us to have that full information of what exactly they are doing with TikTok and other apps.
They've actually come out and said they're not going to allow them to divest. So that's part of the reason why I think a lot of people would agree with you. Can you help me understand why exactly this got attached to aid to Ukraine and Israel?
Well, it's a good question, Lisa, because the reason it's getting attached is because it's the only thing that's moving. And Republicans in the House want to get some victories. Republicans are concerned that the Senate was going to slow walk the TikTok ban. This is the way of getting something being a political off-ramp for them to say it wasn't just the Senate passed bill. We got a couple of our priorities in there. And what we've seen from Speaker Johnson is that when he puts something on the floor that is against China, it is the only truly bipartisan thing in D.C. The TikTok bill passed overwhelmingly. A data broker bill that really is going to limit what type of data Chinese companies are able to purchase in the United States passed 414-0 in the House. That's also in this bill. The House Ways and Means Committee is passing a bill that would impact Temu, Shein, other online retailers trying to remove that de minimis exception. Those are the questions I'm getting the most this week at Raymond James is all of this anti-China bills that are live balls that are going to find their way to the president's desk sooner rather than later.
So basically, this is a way to make everyone feel a little bit better as they passed aid to Israel and Ukraine and sort of get them on the same page, which raises this question. How much are the Democrats going to back Johnson if some of the Republicans fade away?
So if Marjorie Taylor Greene is the person who brings up the motion to vacate, there is absolutely going to be enough Democrats on board to make sure that Johnson remains Speaker. If the reason why Republicans are going to try to remove Speaker Johnson is because he brought up essentially the Senate-passed defense bill, they're going to back them. The reason why Democrats didn't back Kevin McCarthy was his role in rehabilitating President Trump after January 6th, his role of making January 6th partisan. That's what you hear from members. Johnson didn't have a similar kind of bad kind of feeling among Democrats. Democrats are going to want to have some level of keeping the House in order.
Ed, can we talk about why we're here? We're in town for the IMF World Bank spring meetings, and I think we're all trying to figure out how long is the line outside of the Treasury Complaints Department? And is it filled with people from Japan, Malaysia, South Korea? Are they complaining about FX and what's happening with the stronger dollar? Are the Europeans still complaining about industrial policy in America? How many complaints is this administration receiving?
The complaints might be long, but I don't think there's going to be a lot that is done with this. Probably about 6 months ago, I was on with you all, and we're talking about the concern has been that the strong dollar or kind of higher yields in the United States was going to kind of cause a lot of problems in the U.S. What we were talking about is how that was really kind of a fusion between the Treasury Department and the Federal Reserve and the fact that was supporting our reindustrialization. And, a lot of folks might want to rate cut, but there's also a lot of folks who love getting the yield out of their money market account. Yeah. Yes, we talk about $1 trillion debt service burden, but that's $1 trillion hidden fiscal stimulus to the economy, especially among wealthy individuals. And guess what? Monday this week, they sent 40% of that back to Treasury, and I don't think they sent that with a thank you note. So they're also lining up in front of Treasury asking for kind of some of their money back as well.
Very well framed. Ed Mills of Raymond James. Ed, thank you. Big issue, isn't it? As always, it's our currency, it's your problem. Seems to be the message.
And frankly, right now, we understand, we acknowledge. What else are they going to do? Nothing. And that's basically what we're hearing.
Coming up on the programme, the conversation continues. We'll catch up with Leland Miller of the China Beige Book, live from Washington, D.C. This is Bloomberg. Equities on the S&P 500 pushing just a little bit higher, firm up by 0.2%. Your equity board shaping up as follows. Well, the S&P 500 doing okay. The Nasdaq up by 0.33%. The Russell, which has been absolutely hammered and was down again yesterday, is positive by 0.1%. It is a 4-day losing streak on the S&P 500, the longest stretch since the first week of 2024. If you switch out the board and get to the bond market, yesterday was a little bit different, Bramo. Yields pulling back, not pushing higher. Yields down again by a single basis point, 4.57 on a 10-year. The 2-year backing away from 5%. Bramo, 492.20.
People are starting to buy. And on the margins, you start hearing this under the surface, whether it's pensions that have bought a lot of stocks and now are going to sell them and move into bonds, or whether it's just this idea, we're not going to get this that much higher. You're starting to feel it. You saw that in the 20-year auction. To what degree, though? When does that get tested? And today, Vanguard was saying if you get to 475 on the 10-year, that's going to trigger a real problem that'll get you to 5% pretty quick.
This FX market is crying for a little bit of dollar weakness, and that's what it's got right now. So let's switch up the board and get to foreign exchange. But we'll look at some different currency pairs. We started the programme this morning as we kick off our coverage of the IMF World Bank spring meetings, talking about the pushback we're receiving from places like Japan and South Korea, threatening to intervene in the FX market. Malaysia actually has done. They've had to step in. It's been weakness, Bramo, across the board for some of these currencies, grappling with the strength of the US dollar. And what are you fighting? You're fighting fundamentals. And that's the problem. How difficult is it to intervene and stop that train?
Well, you can see it right there in the number, 154.47. That's what verbal intervention got you, a whole lot of nothing. And basically, that's what you're looking at, because what can you do? If you're the Bank of Japan, and each of these stories are different, right? But if you're the Bank of Japan, the only thing you really can do is to hike rates aggressively, which you're not going to do. And even that isn't clearly going to get you what you're looking for. So at a certain point, they can jawbone all they want. The market's calling their hand because they're looking at fundamentals.
I keep going back to that meeting in the last 24 hours between the Treasury Secretary and representatives from Japan, from South Korea. This is clearly an issue in Washington, D.C. this week.
Oh, absolutely. You said it best, Jonathan, when you said how many people are lining up outside the Treasury's door for meetings because of the issues they have, whether or not it's Asian countries and they're dealing with the stronger dollar and then the weakening of their own currency, but also in Europe. When it comes to things like the Inflation Reduction Act, there's still a little bit of tension. Also, the fact the United States wants to see harsher sanctions on Iran, that means getting the Europeans involved.
Yeah.
It's a difficult position because they have to give a little sometimes to get a little when they want this multilateral approach when it comes to places like Russia, Iran, and China.
It's an odd occasion, Lisa, because the United States is spending a lot of time complaining about policy in China. And I'm not saying they're wrong for doing so. But the rest of the world appears to be complaining about policy in the United States. And this week, we just hear those complaints on repeat.
Especially given the fact that the U.S. continues to grow, and a lot of people are saying, well, that's because you guys borrowed so much to fuel your fiscal spending, which allowed you to grow so much. At this point, that is going to be the key question. How much is there some sort of coalition of like-minded peers, allies, at a time when there's so much disagreement within said allies? And by the way, that Iran issue, it's actually tied to China. Did you see the story this morning that Iran has actually been accelerating its output of oil and selling it? Who's it selling it to?
The teapots in China, 80%.
Correct.
Last month, 3.5 million barrels a day. This is what was so frustrating when you speak to the administration when they say, well, we have sanctions on Iran. Having sanctions on Iran is one thing. That's a piece of paper. Enforcing them is a completely different story.
It's a conversation they won't entertain, though, right? We tried to have that conversation earlier this week. Didn't go well.
It didn't. And they continuously push and they say that Iran is isolated. It's very hard to see Iran being isolated when they're exporting the oil to China, weapons to Russia, as well as the foreign minister today in New York. That's not isolation.
Brent crude right now down by 1%, $86 and about 30 cents. Under surveillance this morning, our top stories. Cleveland Fed President Loretta Mester and Governor Michelle Bowman urging patience in the fight against inflation. Bowman going a step further, saying progress may have stalled and only time will tell if rates are sufficiently restrictive. What's interesting is the conversation that market participants are having, the only person on the FOMC that's having it is Governor Mickey Bowman, because very few others are having a conversation she's having about whether we are truly sufficiently restrictive.
They don't want to go there, because basically that introduces the question of rate hikes, and they don't want to put that on the table. And that's very clear. They want to take rate hikes off the table, which is the reason why I'm interested in speaking with Jonathan Pingle over at UBS, who starts talking about the potential for a 6.25% Fed funds rate next year if you don't get some sort of deceleration of inflation.
8:30 Eastern time for that one, 2 hours away. Don't miss that conversation. Let's turn to our next story. House Speaker Mike Johnson putting his job on the line, looking to pass aid for Israel, Ukraine and Taiwan. Johnson is planning a series of votes this weekend for the $95 billion aid package. President Biden endorsing the legislation and urging Congress to act quickly. A question we've got for him is the question we had for Speaker McCarthy. Can he pass this and keep his job?
Well, Ed Mills thinks he can. He thinks he can pass all of these packages and keep his job because, of course, like we've seen everything else that comes out of the House of Representatives, the Republicans have such a slim majority, Democrats have to be there for the votes. And Ed thinks because potentially there's not the relationship that former Speaker McCarthy had with former President Donald Trump, it's not as intense the way that the current Speaker Mike Johnson has with the former President Donald Trump, that some Democrats may get in line and vote for him. But then after these bills, it's off to the races and it becomes all about November and the election.
Well, let's talk about the election and the complaints we're hearing from President Biden taking aim at China while surrounded by U.S. steel workers. At an event in Pittsburgh, Biden calling the country xenophobic while pointing to China's economic woes. Leland Miller of China Beige Book saying this: the narrative of China's collapsing manufacturing was always a false read of true conditions on the ground. Leland joins us now for more. Leland, we could talk about the economy. We've got to talk about the politics as well. Are these complaints from the United States, from the White House, justified when they're talking about the prospect of overcapacity and dumping in global trade?
Well, there's a fascinating academic debate going on whether we're at overcapacity or whether we're about to get to overcapacity. But it's compelling enough that Europe is now paying attention and the United States is now preparing its own response. So I think the key thing here is not whether you're seeing the flood of Chinese cars. Obviously, you're not seeing Chinese cars on U.S. roads. This is something about 2025. It's about 2026. The Chinese cars have been in a protective cocoon for about 10 years. Being massive subsidies, massive protectionism inside the home market. And it was very competitive, and now the domestic market is getting closer and closer to being saturated. And they are liberalizing the laws and the rules and the regulations, and these cars are ready to go out. But the domestic market's saturated. There's too many companies. They're going to have to go somewhere. So I think everybody's just looking not at today, maybe not next month, but next year, and saying we have got to prepare a response because this could be problematic.
It's kind of strange to me, Leland, that we're having conversations we've been having for a long, long time. These conversations about dumping are decades old. The goods have changed. We're talking about EVs. We used to talk about something different before. I remember, though, this wasn't going to be an issue. We were having this conversation about the future. China would move away from this manufacturing base. It would be less about exports, more about consumption domestically. What does it tell you about the trajectory of the Chinese economy and where they are, that we're still having this conversation in America?
Well, it hammers home the idea that you need to always see what they're doing, not what they're saying. So, we heard for a decade plus that there was a shift going on from investment to consumption. Now, they downshifted investment. Consumption hasn't gone everywhere. And you see what happened very recently at the National People's Congress last month. They took Xi Jinping's new mantra, which is, about new productive forces, and they announced that is going to be the government's economic program going forward. They're going to have a whole of government program that's going to help these companies in new, advanced, particularly green sectors globalize. So the entire Chinese government is going to be about getting their technology around the world. This is production, production, production. This is why you see exports so high and imports so low. It's a problem because not only does China have trade surpluses with just about everybody, these trade surpluses are going to get bigger and bigger and bigger if they're dumping around the world.
Leila, we're on the edge of these China tariff EVs almost becoming like infrastructure week. Everyone's talking about it for months, going to China and talking about it in their face. Is there a disagreement in the White House? Because why is it taking so long?
This White House disagrees with itself on just about everything. And when it comes to actually putting some sort of policy in place, I think that if you had some of the trade hawks administration, they have been wanting to do this for not just weeks or months, but for years now. And nobody in the White House is willing to give the green light to let them do this. Now it's getting political. We're in campaign season. We're talking not about solar, which is sort of existential for people. We're talking about cars. And cars are political, and this is campaign season. So I think some of the resistance you've seen politically, especially within the White House, to moving forward on some of these trade actions, it's starting to dissipate.
Is a more important relationship that the White House needs to worry about is less so Washington, Beijing, but Mexico and Beijing? Because if the United States ups these tariffs, isn't there going to be a tremendous amount of dumping into Mexico and then potentially leaking into the U.S.?
Well, that's the big worry. So the worry is that, you have this 2%-ish tariff for USMCA across the Mexico border. A lot of Chinese companies are already starting to plan and build plants in Mexico so they can just produce them in Mexico and then drive them across the border, and you miss the whole China trade war part of this. Unless you step in and you deal with transshipment and you deal with the build out of factories in Mexico, that absolutely will be part of the policy response. And that's a lot more legitimate than thinking that, suddenly Chinese waves of Chinese cars are going to appear at U.S. shores.
There's been speculation that China is deliberately allowing its currency to weaken in order to expedite some of the exports of some of their goods. Do you buy that?
I don't think so. I think they're very nervous about their currency overall, and China's sweet spot is stability on the currency, and that makes everything else go better. So I think what they want is, they would want a stronger economy if they could have it. You have a supercharged U.S. dollar over the course of many years, and the yuan, though most people don't realize it, is soft pegged to the dollar. So they have had to keep up with dollar strength for a number of years, and now they're just trying to let off pressure wherever they can without sending a political signal that's going to get them in trouble.
Is it a fiction here at the IMF meetings that China is actually an engaged member, considering the fact that we're hearing a lot of pretty poisonous rhetoric around China from pretty much every member of the IMF?
Well, I think it's become more acceptable to be more critical about China. I think that the issues here have been building the production, the exports, the fact that everyone calls China a global growth driver, but you're not a global growth driver if you're juicing your exports and you're minimizing your imports. What you're doing is actually hoovering up demand from the rest of the world. So I think that has really gotten under the skin of a lot of people, and that sort of negativity on China is something that's not American, it's not European. I think everybody is getting mad at China for that.
The last time we were at the spring meetings for the IMF, we talked extensively about whether the IMF would come up with something that would counter the Belt and Road type of initiatives, that China's kind of going it alone to help different countries and exert influence. Do you see that happening more actively at a time where people are being more vocal in their criticism?
No. I mean, I'm never of the belief that an international bureaucracy is going to get itself together and do anything productive. So no, I don't think we're going to be moving in that direction. I think people are worried about Belt and Road, but at the same time, the Chinese themselves look at Belt and Road and they can't afford what they've planned out. So they're being more specific about what they're actually putting effort and money into and what they're pulling back. So I think there's a lot of issues in terms of China policy. Belt and Road is not front and center in terms of what I think we need to be worrying about right now.
The complaints have just come too late, Lisa, particularly from some of these institutions in Washington. They've come far too late. The hope, and we've talked about this a few times on this program, the hope was always that China would become more like the West and that these institutions would help facilitate that. The fact of the matter is China has not become more like the West. And in many ways, just in many ways, China has been a leech on the global international trade system for a long, long time. And we'd sit here and have conversations with officials from all kinds of places, and they'd be hopeful that that was going to change, that China would move away from this export-led growth, they'd go towards consumption, they'd become more like us, they'd open up, that would continue. That hasn't happened. I think the reason you're getting the complaints now, and we can have these conversations with officials through the week, I think the reason we're having these complaints now is because they lost, and they can't fix it. It's too late. Because what you're seeing in the United States is them slide back into industrial policy. What the Europeans are realizing is they've got to do the same thing. So all of these hopes and dreams of having this globalization continue and China being part of that, it's over. It's over. And I think what these institutions this week have got to figure out is how they find relevance in that world, how they shape some of these decisions that are being made, because it's becoming increasingly difficult. So I've just put a bow on it. They lost. It's done. It's over. It's not going to happen. Industrial policy in the United States, this is the future. We see a massive agreement in Washington. We can disagree over a lot of things in D.C. I can have my own view on free markets. You can have yours. In Washington, where there is agreement, it's on things like this, industrial policy and tariffs and going against China. And the hopes and dreams and they're becoming more like us, forget them. Dead and buried. Gone.
There is a way, though, to do it with more cohesion. And I would like to hear, if there's this idea that maybe the U.S. wasn't necessarily ahead and very far behind when it came to industrial policy. But guess what? Industrial policy is getting revolutionized by new technology. What if the U.S. has an upper hand in being able to recreate and reconstruct an industrial policy with AI, with different technologies, without disrupting millions of people who are employed by that sector? There are ways to play this if you are cohesive about it.
Agreed. Leland, this was awesome. It's just fantastic to get your thoughts, as always. Leland Miller there of the China Beige Book. Let's get you an update on some stories elsewhere. And let's get you the Bloomberg Brief. We can do that with Danny Berger. Hey, Danny.
Hey, John. Donald Trump's campaign wants other Republicans to pay if they use a former president's name, image, or likeness in any fundraising. According to a campaign memo obtained by Bloomberg News, all candidates and committees who use Trump in their fundraising appeals must give a minimum of 5% of the money they earn to Trump's political operation. Shares of Micron higher pre-market, up by 1.6%. It's the largest U.S. maker of computer memory chips and is poised to get $6.1 billion in grants from the Commerce Department. It would help them pay for domestic projects, all of it part of an effort to get semiconductor production back to American soil. The award is expected to be announced next week, according to people familiar. Google has fired 28 employees for protests against Project Nimbus. It's a $1.2 billion joint contract with Amazon. It provides the Israeli government with AI and cloud services. The protests, led by the, quote, No Tech for Apartheid organization, took place in a number of Google offices on Tuesday. Protesters in New York and California staged a nearly 10-hour sit-in, with others documenting the action, including through a Twitch live stream. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the programme, the path to 2%.
What we've seen over the first few months of 2024 anyway, is that progress on inflation has slowed. And I expect maybe it's even stalled at this point.
That conversation coming up next from the nation's capital. This is Bloomberg. Live from Washington, welcome to the program. In the nation's capital for the IMF World Bank spring meetings, equity futures right now just about positive, trying to bounce here by a third of 1%. Yields are a little bit lower by a single basis point, the 10-year 457.11. Under surveillance this morning, the path to 2%.
What we've seen over the first few months of 2024 anyway, is that progress on inflation has slowed. And I expect maybe it's even stalled at this point. We've seen a little bit of stalling in progress in lowering inflation. So I think it is restrictive. I think time will tell whether it's sufficiently restrictive or binding.
Here's the latest this morning. Cleveland Fed President Loretta Mester saying the central bank shouldn't rush to cut rates, adding, quote, I still am expecting inflation to come down, but I do think that we need to be watching and gathering more information before we take action. More Fed speak on deck today with Fed Governor Michelle Bowman, New York Fed President John Williams, and Atlanta Fed President Raphael Bostic. With us around the table, I'm really pleased to say, here in Washington, Tiffany Wilding of PIMCO. Tiffany, good morning to you. Let's talk about Mickey Bowman, because I think Governor Bowman on the FOMC seems to be the only one exploring whether we are truly sufficiently restrictive or not. Why is she so lonely?
It's been so funny that you haven't had more people talking about this. I mean, you can literally just look at the growth numbers and know, we're kind of running 3% on a final domestic demand, so core growth. It looks like we're going to run that in the first quarter, maybe even in the second quarter. We haven't had 4 consecutive quarters of that kind of final domestic demand growth since 2000s. We have a lot of growth in the United States. I would even venture to say the U.S. is quite boomy right now. That does not seem like an economy that has restrictive monetary policy. And of course, in that kind of environment, you would expect inflation to reaccelerate. So I'm with you. I'm surprised she's the only one talking about it.
So we've heard some calls this week, some big changes. The likes of Bank of America, Deutsche Bank now say December. There are some banks who are saying no cuts whatsoever this year, including the likes of SocGen, and Apollo's another name, Torsten Slok, who's basically saying no cuts in 24. Yeah. Where are you in the team now on that issue?
Yeah, so we agree. We think that ultimately they are not going to be cutting in the middle of the year, as they had previously been clearly telling us they were going to do. But I think what they will do at that June meeting, which will be important, is they will show us their new SEP, and that is where we will get, I think, clearer guidance on when exactly they expect to cut. I think there was like a quick rule of thumb that they were using in January, which was that we needed to see 2 more consecutive quarters of 2-point-something inflation. Inflation was 3.4, or will likely to be 3.4 in the first quarter, and our own forecasts are that it's going to be 3 in the second quarter. So if they still need to see 2 quarters of 2 something, then that kind of suggests December might be the first time that they're looking to potentially cut. I think it all depends. They have wiggle room. They can, monetary policy is more of an art than a science in some sense. But I think there's definitely a clear message that's coming from them, at least, that they're not going to be cutting mid-year.
If Mickey Bowman has lunch with Neil Kashkari, maybe even has lunch with Fed Chair Powell and starts to talk about sufficiently restrictive, that starts to put the idea of a rate hike back on the table. Because if you're not sufficiently restrictive and you're looking at inflation that's running hot, well, as Jonathan Pingle over at UBS says, that raises a specter next year of additional rate hikes that he sees potentially even going to 6.5% for the Fed funds rate if we don't get an inflation rate below 2.5%. Do you agree?
Yeah, I mean, so we think that, again, that 3 is a big number, that 3% threshold, so 2 something. So if they're seeing inflation that's reaccelerating to above 3 and looking like it's going to hang there, I certainly think that that'll be a problem for them. In terms of how they message it, I think it has to be a message of policy is not as restrictive as we thought. Therefore, the underlying neutral rate in the economy is maybe a little bit higher than we thought. And that's a longer-term issue. And by the way, they have a longer-term review of their monetary policy strategy coming up in 2025. So, going through the exercise, the academic exercise of reviewing all these models, and thinking about that, it's kind of an opportune time, if the economy is behaving like that, if inflation is still above 3, to really start to talk about maybe neutral interest rates are higher.
It becomes incredibly difficult as an investor to understand how to play this, especially when the relationship between stocks and bonds has gotten so confusing over the past few years. You believe that eventually we're going to see a sort of going back to the old normal of bonds and stocks moving inversely. How long will it take to get there, given that we don't really even understand what sufficiently restrictive means? And if you get higher yields, that might not be positive, or that might be really negative for stocks. We just don't know.
Yeah, so we think that we're getting closer to that kind of environment now. And the reason is just because we're not at 8% inflation anymore, right? So, at the end of the day, we're talking about, are we going to get 2 something? Maybe we get a little bit above 3. But I don't think anybody is really estimating, with absent some supply shock, that inflation really materially reaccelerates. So in that kind of environment, the Fed can still be as reactive to unemployment rate increases and additional evidence of potential economic downturn as they are to inflation. And it's really that balance of risks being more balanced that gets you that negative correlation between stocks and bonds. So we still think bonds are going to be a good hedge for equities here.
Do you think the Fed needs to start thinking about just targeting 2 to 3%? Instead of talking about going right back to a laser precision 2?
Yeah, I don't think they will ever admit to that. Certainly that will be more of a discussion in 2025, I think, during their monetary policy review. Powell, it seems like from his conversations, has sort of taken that off the table. They are really worried about a credibility issue with raising the inflation target when you can't get it back to 2, which is understandable. But I think if you take a step back, there's just not a lot of academic discussion around what are the cost benefits of 2 versus 0 versus 3. And like I said, there's some wiggle room here, I think. So, I think what could play out is that they're willing to tolerate a little bit of above target inflation for a while. I still think that threshold is 3. They'll always forecast it getting to 2 in the future, but we'll just realize, some higher inflation than target. And by the way, when we look at the TIPS market, I know a break-even inflation rates have increased a little bit, but, that does not seem to be priced into the psyche there.
Then when you look at some of the language coming out of the Fed, and we heard from Powell this week, he's almost implying that the latest hot prints we saw in inflation are not just bombs. And you're almost saying this is the new trend.
Yeah.
Is that correct?
Yeah. I think in our minds, it's always been, you will probably need to see more easing in the labor markets, some higher unemployment. The Fed is basically saying we can achieve all of this, without higher unemployment. And we've sort of been skeptical of that. And I think what you're seeing play out in the economy right now is that you're getting a hot economy, and that is actually putting upward pressure on inflation. You're seeing it in the core services, ex shelter categories, the Fed's, super core measure that they like. But you're also seeing it in shelter. Shelter has really stalled. Part of that is just because we have, the supply of houses. We've underbuilt for the last 10 years. And the fact that you've had a price, a level adjustment that's happened in the housing market, in the rental market, that just the OER has not caught up with. You're just not going to see a fast deceleration there. So all of that sort of suggests to us that, we are kind of in this prolonged period of higher higher than target.
Tiffany, this was great. It's great to see you on tour as well, here in Washington.
Thank you.
Thanks for being with us. Tiffany Wilding there of PIMCO. Echoing some of the things we heard from Stephen Stanley of Santander, the Fed became enamored with the combination of really strong growth and benign inflation. And Lisa, they were looking for that to continue through 24, and there's clearly a challenge to that based on the data we've had so far.
And one of the more compelling arguments is that their embrace of that narrative is part of what has allowed inflation to remain stickier because of the verbal intervention and easing.
Coming up in the second hour of Bloomberg Surveillance, we'll catch up with Alifia Dorawala of Rock Creek, Bloomberg's Michael Shepard, former IMF First Deputy Managing Director, John Lipsky, and Tim Adams of the IIF. From Washington, this is Bloomberg.
The restrictive policy that the Fed wanted in place to try and bring inflation down, now we're starting to see the swing back the other way.
I don't think we're out of the, out of the woods here with inflation pressure.
It's not just that the rate cuts are less than later, but it's also, is inflation higher?
When you look at what's driving inflation, or at least keeping it sticky, a lot of it's supply side factors.
The real risk is the second half of this year, inflation actually starts to move back up again.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
So yesterday you got everything you wanted. You want lower crude prices, that's what you got. Oil down. You wanted a weaker dollar, you got a bit of that as well. Yields lower, you got that too. Couldn't buy you a day of gains in the equity market. 4 days of losses on the S&P 500, longest losing streak going back to the start of 2024. Live from Washington, D.C. this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on tour, covering the IMF World Bank spring meetings with Annmarie Hordern and Lisa Abramowicz. I'm Jonathan Ferro. We've got to talk about the complaints from one side to the other. The complaints from the United States on policy coming out of China, and Lisa, the complaints from everyone else about policy coming out of the United States. That kind of frames this meeting in Washington, D.C.
And frankly, the specter of Donald Trump coming back to the office, how much is that also included in some of the geopolitical risks that people are talking about? It's a fraught moment when you're talking about a trilateral or multilateral world. What are the lateral aspects of it? Is it going to be China, Iran, and Russia, and the U.S. and who, right? Is it going to be the U.S., Japan, South Korea, as well as Western nations when they are having issues with the U.S. industrial policy and the strength of the dollar?
Well, at the moment, America is bathing in U.S. exceptionalism, and the strength of the dollar is a consequence of that. The strength of the dollar is causing problems. And I keep going back to this meeting between Secretary Yellen and officials from Japan, officials from South Korea. To Lisa's point, the dollar at the epicenter of some of these concerns.
Right, and you saw all these three finance ministers get together, and basically they all agreed that the currencies are too weak. And it felt like it was the U.S.'s response and way to say, we understand if you have to intervene. But to Lisa's point earlier, what does that mean? Can they actually go in and intervene? If they do, does it even matter? Because how are they going to fight this Fed? And that's why at this IMF, you hear about this U.S. exceptionalism due to loose U.S. fiscal policy, making it harder to get back to the 2% U.S. inflation target. And what does all of that mean in terms of bond yields and higher dollar on the rest of the world?
Let's go to the quote from the G7 on foreign exchange. Read through this with me. Lisa, excessive volatility, disorderly movements in exchange rates can have adverse implications for economic and financial stability. Is there anything excessive volatility, anything disorderly about the movements we've seen so far? Isn't this all based on policy fundamentals in America versus everybody else?
Well, it's disorderly because it creates a real problem for the central banks in other countries to be able to actually adhere to what actually is best for their economy. So, yes, I think a lot of people would say it's disorderly because it's crossed certain thresholds and they don't like it. Ultimately, it's very difficult to know as an investor what can be done if it is very logical that this is happening. You say disorderly. I'm a bit tongue-in-cheek because ultimately this is a direct derivative of the fact that we're talking about U.S. exceptionalism, tighter Fed policy on the heels of inflation, and a weaker economic growth in the rest of the world. That's textbook for what you're going to get in terms of the currency move.
And if you're concerned about U.S. fiscal policy, the IMF is talking about the fact that they don't see a short-term fix for this because, and you mentioned former President Donald Trump, he's in the mix because it's an election year. And what happens during election years? You spend more and you tax less. So that loose fiscal policy, that's going to continue.
So everything great here. Plenty of complaints abroad. The managing director of the IMF is warning about the tepid 20s, tepid growth for the next decade or so. Lisa, if we don't adjust some of these big issues of the moment.
And I don't want to say it, but are we talking Liz Truss here?
Is this basically where we're going with this? Basically, the talk about the fiscal overhang.
I think you're talking Liz Truss.
Well,
I'm not sure
hold on a
Liz
second.
Truss.
I just have to say, if you take a look at some of the charts coming out of the IMF, the U.S. debt to GDP ranks up there with China and India. It is above where Brazil is at. They are talking about this as the major risk. I find it fascinating. Crises usually happen in areas that are perceived as the safest. And right now, that's what people are looking at with the Treasury market, understanding when does that happen. Of course, this is all pie in the sky for people who want to invest in Treasuries today when they're looking at the incremental moves, which is the reason why people haven't been talking about it more. But I find it fascinating, and the IMF does too.
The former Prime Minister is on a book tour at the moment. If you wanted to get her on the programme,
well,
that would
Truss,
be a good conversation.
I would love to speak with Liz Truss.
I know you would.
Please, let's
would.
make that happen.
You can run that conversation.
Thank you.
Equities right now on the S&P 500 positive, 0.25%. I think it's best I sit out. In the bond market, yields lower by a single basis point, 457.72 on Treasuries. And there's the move. Lisa, we're back down in the low 80s, 81.84 on WTI.
Well, how do you price in geopolitical risk? I mean, again, this is, we could talk about all the what ifs, but if they don't come to fruition, well, then it's a buy because you have, however, 3 million barrels of oil, 13 million barrels of oil being produced out of the U.S. every day. So at a certain point, it's a very difficult trade to get right until you're staring in the face of what you're looking at and what can possibly transpire.
86.38 on Brent crude right now. Coming up this hour, we'll catch up with Olivia Dorawala of Rock Creek with U.S. stocks coming off 4 days of losses. Former IMF first Deputy Managing Director John Lipsky on the Fed's path forward, and IIF CEO Tim Adams on the headwinds facing financials. We begin with our top story. The S&P 500 looking to bounce back from its worst run of losses since the start of the year. Olivia Dorawala of Rock Creek saying this: U.S. equities remain attractive, but it's still too soon to say that the time has come to be all in on small caps. Olivia joins us around the table. Olivia, great to catch up with you. It's a tradition here in Washington. It's good to see you.
Thank you so much for having me.
Let's start with small caps. Everyone wanted them at the end of Q1, and then April happened, and I think we're down 7% off the highs of March, maybe even more now after the losses of yesterday. Why is this not working in the way that people hoped it would?
I mean, I think it's all coming down to the Fed, right? And if you looked at the beginning of the year, we had almost over a 60% probability that the Fed was going to cut rates in June. Now it's at 15% with a 95% probability into September. I think to your point, the markets are all over the place. They finally kind of realized that higher rates for longer is actually what they said and what will happen, that inflation remains high, maybe for good reasons, because economic growth, the prospects are strong in the U.S. And to your point about the rest of the world, maybe relatively to the rest of the world, continues to be strong, even if there are downside risks in the long term. So I do think that, investors that jumped into small caps as a category were probably too early. I do think there's an opportunity for stock pickers.
The key phrase there that you used, for good reasons. Lisa's talked about this a lot. When you see high yields, is that for good reasons, growth, or bad reasons? Inflation, maybe it's even both. And if it is for good reasons, isn't that a good reason to keep buying stocks?
I mean, I think the question is, are we in a new regime where inflation will never get to 2%? So we're all sitting here waiting for 2%, and it just never happens. Everyone wants to look to the past, but the question is, for the next 10, 15 years, is inflation at 2.5% or 3%? And the economy is perfectly fine with that and can continue to grow. And, we'll have to see what other central banks are doing around the world, because they are in a very different position than the U.S. today in terms of their economic growth prospects.
When John is talking about diversification, the broadening out of the rally, I think about all of those European stocks that people wanted to buy. The granolas, right? We were talking about luxury getting skinny and the tech coming out of that region. Then what you got? LVMH. People aren't buying Hennessy as much. You get the feature of ASMR and the fact that maybe people aren't buying as much of their chip technology. And that was part of what fueled the sell-off yesterday in big tech in the U.S. And frankly, it's torpedoed what we're seeing in Europe. So how do you play that?
Yeah, well, I think Europe is a perfect case of why this is a very good active management environment. If you look at unprofitable tech in the U.S., it is down 11% from when the CPI numbers came out and 27% down from the beginning of the year. That is a very different case than what we saw last year. And I think the same goes for Europe. I think the granolas might have very strong growth prospects, and you can stock pick your way through Europe. But I think economic growth prospects in Europe as a whole are probably not where you would put your marginal dollar if you're betting on growth across different regions today.
Are you worried about the U.S. deficit?
Yes, but everyone has been for the last 10 years, and everybody will be for the next 10 years.
So this is the issue. When does it become a market issue? Because we've been all worried about it. Yes. We've been banging the drum. I remember my grandfather coming into his house, having breakfast with him. The deficit's too big.
And that was like
everything. This runs the family. This is like 30 years ago, you know. But at what point does this actually become real?
I think it only becomes real when somebody actually puts a solution on the table, because no solution will be good. Pain will only come with any solution, and nobody wants to deal with that. That's when the markets will react.
Well, you're based in Washington. What's the catalyst? Is it going to be them saying, like Lisa, look at this is unsustainable, we need to fix this in Congress? Or is it going to the market forces them to?
I think the market will force them to at some point, but I don't think necessarily that it's in the near term.
Are you so concerned about the U.S. deficit that you like gold?
No, gold is a diversifier in our portfolios. We run diversified portfolios, public markets, private markets. There are opportunities everywhere, but we need to be also mindful of downside risk. As much as there are pockets of opportunity in the U.S., in private equity, I mean, that's a whole nother area of really good return investment opportunities. We look at gold as a diversifier, and it's worked up until now.
What do you think it is about this regime that's leading gold to multiple all-time highs over the last few months? What is it about this particular regime?
About this particular, I do think that it's a realization of investors that we are in a higher interest rate for longer, that inflation is here to stay. How do I look at my portfolio, and how do I play some sort of defensive type downside risk? How do I make my portfolio more resilient? Things like gold, and not just gold, but other safe assets are going to be a part of investors' portfolios. I think there are the investors that are looking for short-term momentum, commodity type plays, and there are those that are looking for really how to protect your portfolio.
What's that line? The drugs don't work, they make things worse. It's that treasuries now. They don't work anymore. Is that what you're saying? Go to gold because the treasuries don't work, they make things worse.
No, I think again you have to have both treasuries and gold.
It's also how drugs, what British doctors do. They don't want to prescribe a lot of drugs and they don't work anymore, and you get too used to them.
It's an actual song. Do you not know that song?
No. I just think it was.
Why don't you sing it?
I'm not going to sing it. Alifia, thank you. I've got to leave it there. Which is probably a good time to leave it there too. Alifia Dorawala of Rock Creek. Do you not know that song? Everyone knows that song. Equities right now on the S&P. Positive by 0.25%. Let's give you an update on stories elsewhere. We can do that with your Bloomberg brief. Let's cross over to Danny
Hey,
Berger.
John. Donald Trump's advisors are pushing to keep a cap on the state and local tax deduction. Economists Stephen Moore and Arthur Laffer said that they are opposed to any increase to the $10,000 write-off cap on salt. That limit was imposed in Trump's 2017 tax law and will expire at the end of 2025. Shares of Alaska Air are higher, with the airline expecting second quarter profit to come in above analyst estimates. The carrier citing a surge in travel by tech companies and increased demand for premium tickets. The outlook also signals that the company is bouncing back following the temporary grounding of the Boeing 737 MAX 9 aircraft after the fuselage panel blew off an Alaska Air flight in January. Elon Musk says that some of the severance packages sent to former Tesla employees as part of its biggest ever workforce reduction were too low. In an email, Musk apologized and said it is being corrected immediately. Earlier this week, he announced that Tesla would slash global headcount by more than 10% as the car maker struggles with slowing demand. I spoke to Dan Ives of Wedbush this morning, who had quite some strong words to say about Tesla and Elon Musk.
This is the period for Musk. Lay it out. Don't just talk. Walk the walk, because the benefit of the doubt's not there. Yeah. And this has gone from a Cinderella story to essentially Friday the 13th.
And you can, of course, watch Bloomberg Brief every weekday at 5 a.m. That's your brief, John.
Danny, I've got to ask, has he still got a buy on the stock?
He does. He still has an outperform on the stock because he said he believes in the long-term story. It's not given up yet.
Danny Berger, thank you. Even saying those things, Bramo, still got an outperform on that stock. What's going to change it for him?
Honestly, I'm not sure, because ultimately this comes down to you got to believe. You're either in it with Elon Musk and believing that he's an innovator outside of cars or batteries or tunnels or, the Boring Company, or else you don't.
He's certainly an innovator, without a doubt, but the stock hasn't performed at all this year. We're down by more than 30%. Equity futures right now on the S&P, positive by 0.2%. Up next on the programme, the clock ticking on the TikTok bill.
Sometime next year, TikTok is going to either have to divest its Chinese ownership or shut down here in the United States. My bet is probably shut down.
We'll talk about that bet in just a moment. Did you find the song on Spotify?
Yeah.
You found that? I don't think you can play it.
It's the verb, the drugs don't work, but it's kind of depressing.
It's a very depressing song.
Well, so is the deficit.
Fantastic feedback. That song is an English thing, apparently. It's just an English thing. I thought it was a global
the verb,
thing.
The verb is known. We're not depressing.
Not a thing. Okay, not at all. No.
Well, not on this side of the table.
Okay, sure. All right, let's leave that there. Equity futures on the S&P positive by 0.2%. In the bond market, yields pulling back just a little bit. We're down a basis point, 457.92. Under surveillance this morning, the clock ticking on the TikTok bill.
TikTok's the time is numbered here. This House bill is going to pass. It overwhelmingly passed previously. And so those 4 bills are going to be combined. Those 4 bills are going to pass the Senate. And sometime next year, TikTok is going to either have to divest its Chinese ownership or shut down here in the United States. My bet is probably shut down because I am not quite sure that the Chinese Communist Party is going to allow that divestment to take place.
Here's the latest. Congress moving forward with a bill that would force TikTok's Chinese parent company ByteDance to divest its ownership of the platform, with Speaker Mike Johnson tying the legislation to foreign aid package for Ukraine and Israel. The bill's set to clear the House on Saturday, with the Senate expected to quickly take up the measure, and President Biden promising to sign it immediately. Joining us now is Bloomberg's Michael Shepard. Mike, I think Lisa asked the question of the morning. Why on earth are we linking TikTok to aid for Israel and Ukraine? Why is this happening?
Well, strategy-wise, think about it. If you're a member of Congress and you have something that you want to see passed, if you see something else that is definitely going to get through, what do? Well, you try to attach it to that piece of legislation. And we saw this with something else. There is also another measure, an Iranian oil sanctions measure that Annmarie, I'm sure, is aware of, that also was attached to this. And so this is a fairly common legislative strategy. The issue was that, while the House had overwhelmingly passed the measure initially about a month ago, the Senate was slow walking it. There were more objections in the chamber to the bill. They were concerned about whether it would infringe on free speech. There were others who were actually concerned about a possible lawsuit, that it could get blocked in court. The precedent of singling out one company was also something that troubled them.
Do you think they'll slow walk this?
No, it really, because it is attached to this Ukraine, Israel, Taiwan aid package, it is written in the stars that this thing will get through, barring some last-minute drastic change that will pull it away.
So it might not slow walk on Congress, but in the executive branch it could. Couldn't Biden also, though, get an extension on this so he can then campaign on TikTok through November? I mean, isn't that what it comes down to?
Well, that's a great point, Annmarie. And the other thing to remember is that the bill, as currently written, gives the company up to a year to divest, ByteDance, to divest the TikTok platform. And so that would take it beyond of course, the 2024 election timeframe and well into the new administration. And whether it's Biden or Trump, they could then make a decision about how fast to proceed and whether to actually take an action that would force the sale.
Lumping all these priorities and packages together, having these big votes, Ukraine, Taiwan, Israel, TikTok, sales of Iran oil, there's something for everyone in the House. So then you have to think, why would his own party get rid of him and have this motion to vacate? There's got to be something in there for every single member of the House of Representatives, giving the long list of provisions that they're going to be voting on.
It's a great question. This power dynamic that we're seeing in the House right now, there's one word that could best describe it, is really entropy. We're just seeing this disorder there, and it is hard for anyone, be it Mike Johnson, his most recent predecessor, Kevin McCarthy. It grew increasingly difficult for them to bring the Republican caucus into line. And one of the reasons is that a lot of these members really are less concerned about a broader agenda. The agenda that they have is often very unique to them. Somebody like Matt Gaetz, somebody like Marjorie Taylor Greene. And so what they're looking for is it's easier for them to go after Mike Johnson than it is to try to rally the troops to hold together.
I'm going to be optimistic here.
Wow.
I just want to point that out.
Chef's in shock.
Well, I think you're in shock, but I'm going to be optimistic and say it feels like maybe people are getting sick of the dysfunction, and people on both sides of the aisle want to make it stop. And I got that sense from the fact that a number of Democrats were saying, you know what, we're going to vote along with this, and we will vote for you, House Speaker, in order to preserve some sort of sense of order. This from Florida Representative Jared Moskowitz. Massey wants the world to burn. I won't stand by and watch. I have a bucket of water. Is that true, or is that just lip service?
Well, I think you raise a good point about how Congress is facing a reckoning. We talked about a reckoning for TikTok. Congress is facing a reckoning on the question of whether it can govern. And we see these really crucial bills on foreign aid to hotspots like Ukraine in the Mideast and, of course, Taiwan, which, many in Washington fear could be a future hotspot. They're beginning to see the weight of that. And, as the saying goes, heavy lies the head that wears the crown. And Mike Johnson is feeling that weight these days because does he want his legacy as Speaker to be that he couldn't govern, couldn't get his coalition or the House to pass anything? So he is willing to accept Democratic votes and support to get some of these things through.
Why are we not talking about the way that Ukraine funding is being proposed as a loan now instead of just pure aid? And this is basically a nod to what Donald Trump wanted all along. This was his proposal. Mike Johnson went and kissed the ring. Now he's saying he's proposing this. Does that have any pushback, or is this basically anything that the U.S. can give Ukraine? Let's go.
I think they're at the point where they can't be too picky. They can't be too choosy. They need to take what they can get and get whatever support, additional support they can to Ukraine right now. The situation on the battlefield is so urgent, and Ukrainian officials have made that abundantly clear during many visits to Washington, including meetings in this office with our own Bloomberg colleagues and journalists. It is really urgent for them to get this aid so that they can, stave off this intensifying Russian offensive.
When it comes to Congress, is Trump still wielding his influence? Because I was really struck that Andre Duda spent hours with him yesterday in New York. You had David Cameron spending hours with him. These are individuals who are staunchly supportive of Ukraine.
It is interesting that Trump is reaching out to these foreign leaders, including the Polish president. They do have a history there, as you remember, Fort Trump. But, the question of how that connects to his sway over Congress, I think that it's, they're sort of parallel things. These leaders recognize that Trump very well could be the next president based on the polling, including Bloomberg's own Bloomberg Morning Consult poll, which shows him ahead in key swing states. And they have to make this outreach now. They have to build this bridge now rather than wait until he's sworn in to at least understand what the former and potentially future president may be planning.
When it comes to China, there's not going to be a lot of difference between Biden and Trump. And I'd love to get your sense, because we're hearing so much about the China EVs potentially on tap. How are you reading the tea leaves?
Well, the tea leaves, I think you read it really well, Annmarie, that between Trump and Biden on China, there is not a whole lot of daylight. Where you'll see differences are in specific areas of policy. Yesterday, we saw Biden calling for 25% tariffs on certain Chinese steel and aluminum products. Naturally, he made this pitch in Pittsburgh as he was defending U.S. steel being in American hands. So that does sound like something that Donald Trump would say. Would he write the policy exactly the same way? Not totally sure, but it doesn't seem too far, too much distance between the two of them.
How dependent are we on Chinese steel in this country?
The demand for last year was $1.8 billion, so it's 0.6%.
Not a lot.
Not even a percentage, exactly.
Every single story, and I'm not talking about our stories here at Bloomberg, of course. I'm talking about every story outside of Bloomberg needs to have that quote in there. It needs to, because this is about political messaging. This is not actually about economic consequences or anything like it.
Absolutely. And if it was bigger, you'd think they would have done this prior. They wouldn't wait till just a few months before the election standing in Pittsburgh. The one place that when I talk to officials over the past few days, they're concerned about is Mexico. And that's what Leland Miller was talking about. If China dumps on Mexico, how does that just easily leak into the U.S.?
It's fascinating. Shep, this was great. It's fantastic to see you in person. Thanks for having us.
Yes.
Michael Shepard here in Washington, D.C. Coming up next on the programme, we'll catch up with the former IMF First Deputy Managing Director, John Lipsky. That conversation just around the corner. Live from Washington, D.C., with equities doing a little bit better on the S&P 500, positive by 0.25%. In the bond market, yields, can we call this stable? I won't use the word calm, Bramo, but
Thank
stable
you.
for now.
Yeah, sure. But wait a couple minutes, see what happens. Remember yesterday? We started a little bit up, and then, whoo, we got the, earnings. We got concerns about other things. I don't even know what happened.
457.92 on a 10-year. Live from Washington, this is Bloomberg. Things are steady. We're doing OK. Equity futures are positive by 0.2% on the S&P 500. The move in bond yields just shifting a little bit lower recently as well. There's your S&P 500 up 0.25%. The Nasdaq up by a third. If you switch up the board and turn to the bond market, the 2-year, 10-year and 30-year just settling down a little bit. We were talking about 470 only yesterday on a 10-year. Now we're talking about 458. On a 2-year, we breached 5% twice in the last week. We're back down to 493.48. As our good friend TK might say, Bramo, crisis over in the bond market. Would you go that far?
Well, come on. You know that I'm not going to go that far. You're just setting me up to wind me up. I mean, look, this is the issue, is that we've seen these moves every single day. If something happens, you get a 20 basis point swing. If nothing happens, maybe you kind of meander around the same place and you'll get some buyers coming out in the corners. But you got headlines like today, Vanguard coming out saying all it takes is heading to 475, 4.75% on the 10-year. And suddenly all the potential buyers get pushed out of the water and all of a sudden you get straight up to 5% and oh my God, Armageddon for everything. So, you have all of these potential scenarios, and right now it's calm.
No Armageddon right now. Let's switch at the board. Potentially Armageddon in foreign exchange. The dollar's weaker. Everybody seemingly outside the United States hoping for some dollar weakness, and that's what you've got on the screen at the moment. Just a little bit against the Korean won, a fair bit, to be fair. And we should probably talk about what's happening in Asia because I think it's really important. South Korea and Japan are threatening to intervene. Malaysia actually has done. And this stronger dollar story, Lisa, is poison for some of these authorities because they can't do much about it.
Well, they can't do much about it, especially if they need to cut rates and especially if they need to keep a looser monetary policy, I should say, because for the ECB, it's cutting rates and for the Bank of Japan, it's avoiding hiking rates further. The question is, if the U.S. is truly exceptional in terms of its growth and inflation doesn't come down, what else can you do without responding from some sort of monetary policy type of level? And that's something they don't want to do.
The Japanese finance minister coming out of his meetings had this to say: I hope you'll read the statement as it is. It is serious concerns rather than ordinary concerns.
Serious, not ordinary.
Serious rather than not ordinary.
It was serious at 152, more serious at 153.
Just continuously
more
gets
serious
more
at 154.
serious.
OK, let's turn to our top stories. Under surveillance this morning, President Biden turning up the heat on China, calling the country, quote, xenophobic, and highlighting their economic problems during a campaign stop in Pennsylvania. I have to say, AMH, that's some pretty strong stuff to accuse a country of being xenophobic.
Absolutely. And when you heard similar rhetoric from the former president, there was a lot of pushback. Outrage. This is what Beijing had to say early this morning. I saw their statement. I would like to ask him, this is Beijing's foreign affairs spokesperson, to Biden, are you talking about China or the U.S. itself? So what they're talking about is basically, how are you saying we are xenophobic when this language continuously comes out of the United States?
Yeah, that's going down a messy path. Let's put it that way. Focus on trade and economics, and we'll do our best to do that around this table too. Let's talk about some of the earnings coming out of Asia. Taiwan Semiconductor enjoying its first quarterly profit increase in a year. Strong AI demand, reviving growth at Asia's biggest company. TSMC also delivering a better than expected outlook. Shares of the chip maker up more than 35% so far this year. Lisa, some decent news on the earnings front.
Yeah, well, today we heard decent news. Yesterday, we got ASML out of the Netherlands, and it came out below expectations. They said it was just a corrective cycle. Which is it? Yesterday, we saw NVIDIA go down. Today, we're seeing it go up. And it's sort of like, pick your narrative on each day within specific sectors or within the macro. And I think that's sort of my takeaway from this. It's sort of unclear what this means for Apple. It's unclear what this means for the semiconductor super cycle.
We just went from one story talking about the increased rhetoric, the acrimony between Washington and Beijing, and then we're talking about how TSMC is just absolutely nailing it. there are concerns, long-term concerns, not just about the pathway for AI and how long this rally can go, but also how safe the Taiwan Strait can be. Every time I think of the TSMC, I just come back to the constant friction between these two countries, China and Washington, and how this is a company that is bang in the middle.
Dominating the meetings here in Washington this week. Elsewhere, a slew of Fed speak on deck today. We'll hear from Bowman, Williams and Bostic as strong US data and sticky inflation leaves traders reconsidering the path for rate cuts. The IMF's World Economic Outlook describing the US economy as, quote, overheating. Former First Deputy Managing Director John Lipsky writing, quote, despite the first quarter CPI data, it isn't clear that inflation is accelerating, calling into question the claim of overheating. John joins us around the table. John, hello and good morning.
Good morning, Jonathan.
We've got a lot
to
talk about, And I think you're the ideal person to talk about some big issues here in Washington. It strikes me as interesting that we are lacking an institution who is really coming out swinging and fighting against the drift towards industrial policy and protectionism over the last few years. How can an institution like your old one, the International Monetary Fund, regain that relevance so they can help shape and guide us towards more optimal outcomes?
Well, it's a good question. And, of course, the institutional response to the global financial crisis was to create the G20 leaders, and they took it on themselves to take the leadership role in these kind of issues. And what you see is the inability of the G20 structurally to deal with controversial issues like this. They can't even agree on a communique at the ministerial level. The fund is going to have to keep working. There's no easy way because there's so much, as we just heard, there's so much politics and geopolitics involved in this policy. Or this move toward more protectionist policies. Despite that, global trade is growing this year. So there's still a gap between the reality and the rhetoric. The important and the difficult prospect is that this trend will continue and protection will become more embedded through industrial policy or other protectionist measures.
What do you think, John, right now is the epicenter of global instability? I think a few years ago we might have said China. Could it possibly be the United States and U.S. policy now?
Well, the U.S. is, as the IMF World Economic Outlook pointed out, is performing in an exceptional way. The question is that sustainable or temporary? Is it produce as we said, you said just a few minutes ago, the IMF called it overheating. But that's not so obvious in the data. And the IMF's own figures point to an easing in growth in the U.S. next year. So it seems to me that it'll be more important to look at the underlying causes of stronger growth in the U.S. Why is growth in the advanced economies is weak, and in the emerging and developing economies falling far behind? As the IMF pointed out, only the U.S. has got GDP output at this time above what had been expected before the pandemic. Everywhere else is behind, and for the poorest countries, they're the furthest behind. In other words, scarring has been important and more important for less developed countries. This was going to require not just rhetoric, but some deep thought and action of how to boost productivity and growth in these countries.
It's fascinating that in this memo, in this statement, they talk a lot about fiscal debt. They talk about the U.S. debt in particular as being problematic, when some might argue that's the reason why the United States doesn't bear the scars of the pandemic. What did you make of that?
Well, they themselves said that the exceptional growth was due in large part to more expansionary fiscal policies. But it seems to me that we're going to have to look and think about, is it, for instance, labor market flexibility, differences in labor market flexibility that have produced some of this result? Remember, in Europe, the response to the pandemic was to provide a boost that tied workers to their job. And so it meant after the pandemic, everyone went back to the same place that were before. In the U.S., the support was much more to individuals, and you've seen much more scrambling of the economy in terms of which sectors have surged forward, and a more flexible adaptation of technology here than elsewhere. So there's much more to it than just fiscal policy.
To piggyback on what John was talking about how no one's really beating the drum right now about free trade and the concept of what that can do to the global economy. Do you think that this is an IMF that can survive?
Oh, yes, absolutely. What I think has the recent developments have shown is the importance of multilateral institutions as a place for dialogue. Obviously, we're going through a very difficult time. I think back to my period at the IMF during the global financial crisis. There was a real sense if we don't hang together, we will all hang separately. And you didn't have a sense of great power conflict in trying to figure out how to move forward. I think what we're seeing now is an environment of conflict of still uncertain degree, that the global economy is not performing well. As the IMF points out, global growth is slowing. I think that it's going to take, obviously, return to effective multilateral action, open markets, open financial markets, open trade markets to get global growth back growing again. So these institutions are going to be critical, but it's not easy because for obvious reasons.
John, how is that possible when you have the current administration talking about even more tariffs on China and the potential next administration, if Trump was to get back in, a 10% wall on all imports into the United States, 60% on Chinese imports?
First of all, it's not obvious industrial policy is going to produce good results. It hasn't in the past. It's not obvious that protection is going to produce better economic results. In fact, it's likely to produce higher inflation. And if there's a risk that markets perceive, that investors perceive, it's if we turn towards accelerating or higher inflation over the medium term, people have based their own personal financial situation on an expectation of continued low inflation in the future. If that's not going to be the case, there's going to be a reassessment, a really profound reassessment of the outlook that could produce pressures on fiscal policy because that means higher interest rates, higher debt service costs. It's going to start eating up budgets. It's going to put governments in a much more difficult position. So all this talk about protection, industrial production, continuing substantial deficits really is going to, I think, likely to eventually undermine the medium-term outlook and have to produce some results.
If the world stays on that path, where are the consequences going to be felt most acutely?
Well, so far, it's the poorest countries that have suffered the most from global inflation, from disruption, et cetera. They're the ones who have suffered, and they're the ones least responsible for what has gone on. Happily, the multilateral institutions still exist for a dialogue in which these issues can be dealt with. Not solved quickly, but if these institutions went away, we would feel their loss intensely.
We started the week with our good friend Mohammed Al-Arian, and he said he wasn't confident, he was hopeful. Are you hopeful about addressing some of these issues or confident we will?
I'm hopeful.
Yeah, I thought so. John Lipsky, John, thank you, sir. Really smart stuff, as always. Appreciate it. Thank you.
It's always a pleasure.
Thank you very much. John Lipsky there, the former First Deputy Managing Director of the International Monetary Fund. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief. We can catch up with Danny Berger. Hey, Danny.
Hey, John. Jury selection resumes today in the Manhattan hush money trial of Donald Trump. 7 jurors have been sworn in so far in the first ever criminal case against a former president. The selected jurors include 4 men and 3 women. 11 more spots, including 6 alternatives, still need to be filled. The trial is expected to last between 6 and 8 weeks. It convenes every weekday except Wednesdays, and of those, Donald Trump is required to attend every single day. Doha's Hamad International has been named world's best airport. It edged out 12-time winner Singapore's Changi in the Skytrack World Airport Awards. Asia had a strong showing in the top 5. Seoul and Tokyo's twin facilities took the 4th and 5th spot. Hong Kong's airport saw a significant boost. It's moved up 22 positions to 11th place. The World Health Organization is wading into the world of AI, but not always with the best results. It unveiled a new chatbot that, yes, it's available 24/7 to provide basic health information in 8 different languages, but the WHO warns that some responses may not always be accurate. Some of the model's training is years behind the latest data, and the bot occasionally provides weird answers to users' questions, what's known as hallucinations in the AI world. That's your brief, John.
Danny, thank you. Based on the pandemic, I'm not sure if I'm more concerned about the WHO or the bot that comes out of the WHO.
My advice, and I shouldn't be giving anyone medical advice, is do not use this and go see a doctor.
Yes, that's good advice. Good advice.
I mean, all of us have used Google. Come on, Dr. Google. Haven't you done that before?
Pretty much every single symptom.
100%. You have cancer.
I know. Up next on this program, banks navigating through uncertainty.
There are still big macro risks in the marketplace. Strength and stability seems to be a bigger presence in the strategic boardroom of these banks. They are building these banks to make sure they can withstand any challenge.
This show is becoming very depressing today, isn't it?
I'm sorry. I'm going to try to be more optimistic.
I'm going to go and catch up with the managing director of the IMF.
I'm trying to get more optimistic.
So you enjoy yourselves.
Thanks.
Or not. Whatever. Take your pick. From Washington, this is Bloomberg.
Was it me? John left. I don't know. He's going to go.
I think it was you.
All right. Well, it's
all right.
Dark. Welcome back. This is Bloomberg Surveillance on a dark and stormy day. Actually, it's not. It's actually a very energetic morning here in Washington, D.C. We do see a bit of a bounce in markets, but it is the IMF meetings that really is front and center. S&P futures up about 1/3%, trying to climb. Eurodollar basically flat as you hear verbal intervention or the attempts of it, with people worried about a strong dollar. 10-year yield doing absolutely nothing right now as we try to parse out how we think about the fiscal deficit, how we think about inflation, how we think about a Fed response, and frankly, the fact that you're still getting 4.6% on a 10-year yield looks pretty good and people are buying. Right now, under surveillance this morning, let's get straight to it. Banks navigating through uncertainty.
There are still big macro risks in the marketplace. And I'll tell you, when I talk to bank management teams, it's almost like I feel like I'm having a credit analyst discussion more than an equity analyst discussion. They're very focused on their own balance sheet. I think strength and stability seems to be a bigger presence in the strategic boardroom of these banks. They are building these banks to make sure they can withstand any challenge.
Here's the latest. The IMF lifting its expectations for global growth, but warning financial institutions of headwinds, including persistent inflation, rising geopolitical tensions, and key elections in some of the world's biggest economies, including the United States. Tim Adams, CEO of the IIF, writing, quote, instead of talking about flexible exchange rates, we're talking about how to prepare for a world that is getting more and more dangerous. For the first time, geopolitical risks are the number one focus, especially the U.S. election. Tim joins us now. Tim, wonderful to see you.
Good morning. Good to see you.
You know, it was really interesting when I was reading your notes. You talk about how usually it's something of a sleepy affair. People kind of get together.
Pretty subdued in the spring.
Subdued, bureaucratic kinds of, hubbub. This is different. Why?
Geopolitical risks. People are concerned. You have war in Europe, war in the Middle East, which could grow, tensions in the Asia Pacific. So it feels like a very dangerous world. People keep making allusions to the 1930s. I think that's probably overdone, but certainly something we should consider.
Part of the problem with some of these discussions is it's very hard to know how to prepare for something where it's a very bipolar kind of outcome. Are people actually hedging that kind of risk, particularly with the respect of the areas that might get hit hardest in the economy as a result?
Yeah, everyone's preparing because you just don't know. The uncertainty just overwhelms all calculations. The economy is good. As you noted, growth is exceeding what was expected this year. The U.S. economy is humming right along. So from just a growth perspective, we're exceeding expectations, but people are still nervous.
Is the U.S. economy too good in terms of it's so good here that it's dealing with some pretty fraught consequences around the world?
Well, I don't think it'd ever be too good. I think there is other countries looking and saying, how can we replicate that? And why aren't we doing what the U.S. is doing? The U.S. consumer continues to power ahead. So I think there's something to be said for that. Maybe lessons to be drawn from the U.S.
But the U.S. is doing more of industrial policy, especially fiscal policy, loose fiscal policy. The IMF report has talked about this. Do you hear other countries saying, well, if we're not going to have as robust global free trade, that's the direction we need to lean into?
Well, I would hope we go back to robust global free trade. I think that's the right answer. The fiscal deficit, 6% of GDP, is not sustainable. There is a lot of fiscal support. Debt and deficits are part of the conversation this week. I think there's a lot of concern about where we're going to be and the sustainability. I don't think it's sustainable. But right now, it's providing a real pulse to the economy.
So let's take a step back and talk about what the main issues are that financial firms are looking at and actually trying to hedge against as they prepare for this more dangerous world in a whole host of different ways. You point to oil in particular and saying that it could surge 40% globally next year, or even this year, if you start to see a protracted and escalating conflict in the Middle East. Do you see firms actually preparing for that, or do you see them as incredibly vulnerable to a situation like that?
No, our firms are in the risk management business. They're all looking at different scenarios and have for some time. It's not a surprise that oil prices could surge, but it's energy prices generally, and that goes back to industrial policy. If you want to support manufacturing, energy prices are one of the most important component input to manufacturing. So it's not just throwing more fiscal dollars at a certain sector. It's how do you get energy prices at appropriate level.
I hear you talking about how they're prepared for it. They're in the risk mitigation business. We hear that in a host of different ways. Does that mean that you don't see the likelihood of some sort of banking crisis or some sort of banking kerfuffle, or whatever you want to call it, akin to what we saw even last March, just simply because they are prepared for higher interest rates, they are prepared for higher oil prices, they are prepared for a potential slowdown?
No, the system is highly capitalized. We have a tremendous amount of liquidity, very good risk management systems. What we saw a year ago was pretty idiosyncratic. So I feel pretty good where the industry is, but every day we're spending an entire week scenarioing out different risks. So we are trying to think through what are the array of possible downside outcomes.
One risk that you mentioned when you talk about geopolitics that I thought was fascinating, you talked about the U.S. election, and that was actually one of the geopolitical risks that a lot of people were looking at. What are people expecting from a Trump presidency 2.0 in terms of either deregulation? Is that really the case? Can you game that out?
Sure. I just did a 9-city, 17-day tour across Europe. It's the first question out of everyone's mouth, what's going to happen on November 5th, 201 days from today? And the concern is, what is a Trump administration? I think actually it'll be business friendly. I do think there's protectionism. I do think we'll see tariffs and non-tariff barriers. I don't think we'll see deregulation for our industry. I think that's come and gone. So I think there's a lot of potential chaotic outcomes, just the uncertainty of what a Trump 2.0 would look like.
What kind of tariffs do you actually see potentially happening? They talk about a 10% wall and all imports coming to the United States, and then 60% on Chinese imports.
Yeah, I think it's just part of a negotiation, right? I think that's the opening bid. But I do think there's a proclivity to believe that somehow the biggest challenge we have in the United States is our global imbalance, the external imbalance, and we need to solve that particular equation. I don't think that's the problem. And I think you could end up doing some really bad policy in pursuit of an objective, which I think is of secondary nature.
But whether or not it's Trump or Biden, you see the direction of travel the same when it comes to potentially more tariffs on places
certainly
like
on China. China is on the ballot, irrespective of who's elected or who's running. Yes.
Which raises the question for banks, and this is something that we've heard and seen quite significantly. If you're an international bank, do you get into China? Do you expand your presence? Or do you really curtail it in a more significant way? We saw yesterday Morgan Stanley pulling out a couple of its bankers from the region.
Yeah, I think it depends on the institution. You see some institutions who are doubling down and others who are withdrawing. It really depends on your risk profile, your appetite for risk, and where you're located. I think I'd be cautious being in China, but certainly you can't walk away from the second largest economy in the world. You have to be there, and your clients want you there. So I think you do so cautiously.
So this raises this question because we keep talking about how this is a whole new world, and there is an increasingly protectionist kind of feel at this IMF meeting, and this feeling that free trade isn't as good as it really was thought up to be. Is that the same tone that you're hearing from the members of the IIF?
It's a concern that we're hearing. My industry tends to be for free trade, free flow of capital, free flow of data, free ideas, right? We think that's how you optimize growth. But we don't hear that coming out of political capitals. You hear politicians who think they can micromanage their economies into a better outcome. I think that's a huge mistake.
So what's the biggest risk then right now? Is it the politicians?
Well, it's the politician and misallocation of capital, which won't show up for years, but we can end up wasting a lot of capital pursuing sort of pipe dreams of politicians who think they can outsmart the markets.
So we're here for the IMF spring meetings. How does the IMF as an institution, do you think, really guide the global economy and companies that you work with?
Well, they can provide some intellectual framework, some analytical framework, which is if you choose A, B happens. So I think showing trade-offs. I think trying to hold the sector, the global economy, so honest. You've got finance ministers, central bankers sitting around the table. They can be voices of reason. They can talk to the political leaders. Ultimately, it's about political leaders taking political decisions.
This morning, and I can't let you go without asking this because it's something that's very much on my mind, Vanguard came out and said, if you see Treasury yields go up to 4.75, they'll easily pop to 5. We have Jonathan Pingle over at UBS saying that the Fed could hike rates to 6.5% next year. Could banks withstand that?
They will. I don't think we're going to see a rate hike, but I don't think rates are going down either. And I haven't thought that for some time. I think rates are going to stay where they are. You know, the Fed has done a really remarkable job in inflation, but it feels a little sticky. We saw Governor Bowman last night talk about the stickiness. The last mile was always going to be hard. I don't know why it's a surprise, but I think we'll get there with time.
Well, that seems to be the tone that we're hearing from the Federal Reserve as well. Tim Adams, CEO of the IIF, thank you so much for coming in. Coming up, Ed Yardeni of Yardeni Research, Klaas Knot of the Dutch Central Bank, Jonathan Pingle of UBS with that bold call. And don't miss this, Kristalina Georgieva of the IMF with Jonathan Ferro, who did go down for that, not just simply to avoid all of my gloom and doom. And hey, you know, I have been optimistic to some degree. I mean, honestly, there are a lot of discussions that are very constructive and people kind of looking to, you know, make things better. I think that's great, you know.
It's the darker version of surveillance when Lisa's in the hot seat.
No, it's not. You know, honestly, look at this. We have a rally right now in markets. Look at the rally. It's such a good rally. No, I'm serious. Right now, people trying to buy that dip that we saw with the longest losing streak going back to January. A little bit of a reprieve this morning. This is Bloomberg.
The Fed keeps high for longer, then we will see that slowly wind its way through the economy.
As long as the market still believes they're about to embark on a series of rate cuts, then equities can hold in.
We will continue to see upward inflation pressure and potentially upward pressure on rates.
You still need to see this softness come through, and we're not seeing it across any of the metrics.
The longer the Fed holds at 5 and change, the risk in the equity market is actually increasing rather than going down.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
You can't blame me for the pessimism when you have the head of the IMF saying things like we may be heading into the tepid 20s. Just want to say, welcome back. Good morning. This is Bloomberg Surveillance from Washington, D.C. for our audience worldwide. Annmarie Hordern here. I'm Lisa Abramowicz. Jonathan Ferro is still in D.C., but he's down at the IMF, heading there right now, and he is going to be interviewing Kristalina Georgieva about the tepid 20s and maybe trying to make it sound optimistic. But here we are. The market's trying to get a bit of a bounce. And Annmarie, I have to say, one of the most difficult things has been trying to square all the gloom and doom that we've heard over geopolitics, over the potential uncertainty in the rate regime, with the fact that ultimately things are okay. And that actually, when you look at companies, they're making money and individuals have jobs.
And all this has to do with the U.S. exceptionalism, which is the IMF continuously has been hammering home this entire week, whether or not it's speeches or reports. But the cost that they're talking about, the cost of that U.S. exceptionalism on the rest of the world, this loose fiscal policy, does that make it harder then for the Fed to hit 2%? And what does the strong dollar and higher yields mean for the rest of the world? And how do they deal with that?
And frankly, right now, when I take a look at all of these highfalutin speeches, there are probably a lot of people who just tune out. They say, okay, we hear this all the time. It's lots of job owning. What does it actually matter? I thought John Lipsky was really good there when I said, you know, is the IMF not relevant anymore? And he said, you know, just even to have a conversation and to have people come together and have these discussions, to have South Korea, the Japanese finance minister, and Treasury Secretary Janet Yellen coming together to talk about currency concerns is better than not having those conversations. And that is definitely what we see going on here in D.C.
The question is, they know the concerns are there, and these are serious concerns, was what the Japanese foreign minister said. They're not just regular concerns, they're serious concerns. It seems like the Treasury Secretary agreed because she put her name on that readout. But what does it matter? What are they going to do?
Honestly, this is one of the big challenges for a lot of central banks, and it's not just the Bank of Japan. It's also the European Central Bank. We're going to be speaking with Klaas Knot of the Dutch Central Bank, but also of the ECB, and he is a governing council member at a time when there's a real question about how Europe responds, given that their economy is not expanding to the same degree that the U.S.'s is. And frankly, the euro is okay here, but potentially problematic if you start to get an oil surge and all of a sudden that weakness versus the dollar starts to bite a bit more.
Absolutely. With Europe, it's not just the USD, it's crude, and how much that impacts what is going on in the European market. And how do you fight both the Fed and potentially two hot wars and geopolitics?
There's a lot to worry about. If you took a look at markets, you would have no idea because basically people aren't doing anything in particular. You are seeing a bit of a reprieve after the longest sell-off that we've seen in the S&P going back to the beginning of the year, up about 0.25%. But the nature of the decline was interesting. It shifted around a bit with different reasons. It wasn't just higher yields because they did reset a bit lower yesterday. You are seeing a bit of a reprieve from the dollar strength that just came through in a rip-roaring way with the euro regaining just a little bit. But again, this is stasis, 106.78, 10-year yields really hovering up against the 460 mark, but really calm relative to the past few days. And crude coming in a bit lower, about 0.5% lower. Just again, 82.28 on WTI. A question of at what point we're actually baking in risk premia tied to the conflict in the Middle East. Coming up, Dutch Central Bank President Klaas Knot and why he's still penciling in a June ECB rate cut. Jonathan Pingle of UBS on why he doesn't see the Fed cutting until September in a pretty bold call and what could happen if they don't. And IMF Managing Director Kristalina Georgieva joining Jonathan Ferro on the organization's latest global growth outlook at a deeply uncertain time. Let's start with our top stories. Stocks steady as investors shift focus from geopolitical tensions to the Fed's next move. Ed Yardeni of Yardeni Research saying this: the geopolitical environment is certainly foggy and full of uncertainties. More certain is that the Fed will remain in no rush after hotter than expected March CPI and better than expected retail sales. Higher for longer interest rates shouldn't be a big negative for the stock market if the reason for them is that the economy continues to perform well. Ed joins us now, and I'm so pleased to say he is here. Ed, always a pleasure speaking with you. Thank you for being here. Do you think right now yields are still rising for the right reasons?
First, let me say I don't think it's going to turn out to be the tepid 20s. I still think the most likely scenario is actually the roaring 2020s. I think that the reason yields are rising is because the economy continues to perform very, very well. I think the economy has demonstrated that it's resilient. The economy has demonstrated that it can live with these interest rates. And these interest rates are really back to normal. Prior to the great financial crisis, through the great virus crisis, prior to that period, which was the great abnormal, in my opinion, we had interest rates around these kind of levels. Now, of course, some of the increase in interest rates recently has been because the markets kind of come around to an opinion we've had for a while, and that is at most you're going to get 2 to 3 rate cuts this year. But increasingly, we've concluded that there are going to be no rate cuts this year whatsoever because the economy is doing well, and we still think inflation is moderating.
There's a lot there to unpack, Ed, but I want to just go to the roaring 20s versus the tepid 20s. Can you have a roaring 20s in the United States with a tepid 20s elsewhere in the world?
So far, so good. I mean, that's really been the case. And by the way, one of the reasons we didn't have a recession over the past couple of years is simply because China did it for us. China's had a very significant recession, and their CPI is basically flat on a year-over-year basis. Their PPI is down 2.6% on a year-over-year basis. And if you look at the prices of goods we import from China, they're also deflating. So China's helped to bring inflation down quite a bit on the goods side in the United States. So Europe is in a shallow recession. Well, let's call it a growth recession. It's just not growing much, if at all. And so when you put kind of the global picture together, you get a global economy that's growing, but the leadership, clearly, the tugboat, if you will, is the U.S.
Ed, how much, we're going to be speaking with Klaas Knot of the Dutch Central Bank and also of the ECB. How much do you see the dollar as a threat to that, given the fact that you have the rest of the world weakening and now potentially cutting rates, and the dollar is doing what, of course, it would do, which is rally to a dramatic degree?
Well, it goes back to your previous question. A strong dollar usually is an indication that the U.S. economy is outperforming the rest of the world, and I think that's what we're continuing to see. That's really been the case since we came out of the great financial crisis in 2009, 2010. We've had a strong dollar. The U.S. stock market has considerably outperformed the stock markets of the rest of the world, and as a matter of fact, the market cap of the U.S. is continuing to gain relative to the total world market cap. So it all suggests that the U.S. economy is actually doing well. So I kind of look at it in the reverse. I don't view the strong dollar as a problem for the U.S. economy. I view the strong dollar as an indication that the U.S. economy is doing extremely well.
What does all this mean, though, Ed, if we were to see a spike, more of a spike, heightened geopolitical tensions? Because your latest note is talking about the fog of war. How do you prepare for some of those downside risks?
Well, look, I think the most likely scenario is the roaring 2020s, but it's not the only scenario. I'm not going to tell you that there couldn't be the tepid 2020s. But if I had to put subjective probabilities on kind of decade analogies, I'd say that it's 60% roaring 2020s, like the 1920s. And then I think 20% for a repeat of the 1990s, where we have irrational exuberance, which isn't a terrible scenario. You can make a lot of money on the way up if you remember to get out at the top. And then I give 20% to the 1970s all over again. And that's where that was a prelude to answering your question. It could be the 1970s all over again if the geopolitical situation really becomes much worse and affects the price of oil. And it's not just the Middle East situation, it's also Ukraine using drones to take out or at least to impair Russia's ability to produce oil. If we get another energy shock, kind of the second one of the decade, it would be very reminiscent of the 1970s. And then here we go again with the Fed not only not being able to lower rates, but might actually have to raise rates to avoid another wage price spiral. So, I can tell the bearish story. I know the bearish story, but I think at some point you have to put subjective probabilities on this. And for a portfolio, I think it means you need a shock absorber for an inflation scenario caused by the geopolitics. And that would require overweighting energy, which isn't very hard to do because it's a really tiny sector in the S&P 500. But I'd certainly have energy in the portfolio. And I'm not a big fan of precious metals, but in this situation, I think they make sense.
Well, let's go to precious metals. Gold. Ed, how do you describe what is going on right now in the gold market? A lot of people come on the show and they give us different theses as to why they see gold continuing this stunning rally.
Yeah. Well, in some ways, everybody's looking at the same chart. They're looking at the chart of gold, and for a few years, it's consolidated, it's gone sideways, and then all of a sudden, over the past couple of weeks, it's broken out. And that coincided with the war in the Middle East intensifying. It coincided with concerns that inflation remains sticky and that the Fed won't be lowering interest rates. And then, of course, there's a competition going on between Bitcoin and gold. And Bitcoin has done extremely well. And I think there's some investors who are concluding, well, if I want to have sort of a hedge against everything going wild, maybe Bitcoin's too expensive here, and gold might be a better place to be.
When you take a look at the optimism that you paint, you can paint a bearish story, you can paint a positive one, a bullish one. Yeah. If you take a look at the bullish story, how do you sort of explain a broadening out in the rally based on what you're describing, which is higher for longer, that's clearly affecting some of the small cap stocks? And frankly, we're not seeing a particular boost overseas either to the likes of Europe or even Asia.
Yeah. Well, first, let me say I do think that the stock market in the U.S. probably made a short-term top on March 29th. It's had a heck of a move. And some of that move was based on the notion that we're going to have 6 to 7 rate cuts by the Fed. Now the market's looking at 1 to 2 rate cuts, and I think it's going to get disabused of that notion shortly. But I think that on the bullish side, what we have is the market, I think, has started to discount the roaring 2020s. And I know exactly when it did that. It started on November 30th, 2022, when OpenAI introduced ChatGPT, and suddenly the rage was AI, and the AI-related stocks have done very well. I'm skeptical that it's going to be an overnight sensation in terms of its impact on the economy, but so much money is being spent on this technology and other technologies to increase productivity, which, by the way, has been improving, that I think some of it is going to pay off. And clearly that means that it's not just the companies that make the picks and shovels that will benefit. It'll be lots of companies using these technologies to increase productivity. And as I said, last year was a great year for productivity. So, this roaring 2020s is not pie in the sky. It's not, trust me, it's going to happen. I think it's already starting to happen in some areas of the economy.
So just to sort of tie this all together, Ed, basically you're looking at a bit of chop as people price out any rate cuts this year. So you're in the no rate cut camp, possibly. Right. But then they sort of reassert on fundamentals. Is that correct?
Yeah, the economy does well. And that surprisingly, relative to current thinking inflation does in fact continue to moderate. And I think we'll see that in the PCED.
Ed Yardeni of Yardeni Research, thank you so much for being with us. Always a pleasure. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Hi, Lisa. Norway's $1.6 trillion sovereign wealth fund fell short of its benchmark in the first quarter. It was weighed down by both fixed income and real estate, but to the upside, equities, especially tech. The Norges Bank Investment Management Deputy CEO told me earlier this morning on Bloomberg Brief that despite those tech gains, they're not willing to go overweight the sector.
It has become the biggest sector of our investment portfolio, but it's also a very expensive market, or if not very expensive, it's pretty highly priced. So that's why we're being a little bit careful.
You can watch Bloomberg Brief every morning at 5 a.m. Eastern. Elsewhere, Donald Trump's presidential campaign wants other Republicans to pay up if they use the former president's name, image, or likeness in any fundraising. According to a new campaign memo obtained by Bloomberg News, all candidates and committees who use Trump in their fundraising appeals must give a minimum of 5% of the money earned to Trump's political operation. House Speaker Mike Johnson is on a fast track to approve a bill aimed at forcing the sale of TikTok. Johnson plans to include it in the aid package for Ukraine and Israel that he's teed up for votes on Saturday. 2 Republicans have threatened to try to oust Johnson over the foreign aid, but the speaker is still pushing ahead. Attaching the TikTok measure to the foreign aid bill would force the Senate to accept it as a condition for supporting Israel and Ukraine. And that's your Bloomberg Brief. Lisa.
Thank you so much, Danny. Up next, the ECB opens the door to June.
Growth in Europe has been mediocre and has been much slower than growth in the United States. But on both sides, you have an employment and a job market which is phenomenal.
That's coming up next. You're watching Bloomberg Surveillance. From IMF meetings, we are here in Washington, D.C. This is Bloomberg Surveillance with a little bit of a lift to the market as people take a stock of a 4-day losing streak, the longest since January of 2024. We're seeing a bit of a bounce, although it fades up now just 0.16%. What you could see is the dollar strength fading just a touch, and you could see bond yields pretty much stable. I want to get right to it because this is going to be one of the most important conversations of the morning. Under surveillance this morning, the ECB opens the door to June.
Growth in Europe has been mediocre and has been much slower than growth in the United States. But on both sides, you have an employment and a job market which is phenomenal. We are clearly seeing signs of recovery now, beginning timid and picking up in the course of 24.
Here's the latest. ECB officials gaining confidence to cut interest rates at their June meeting on the heels of downward trending inflation and signs of economic recovery. That timeline contrasting with the U.S. as persistent inflation pushes back rate cut expectations in that nation. Dutch Central Bank President and ECB Governing Council member Klaas Knot joins us now. And Governor, President, all of the different ways that you weigh in on European Central Bank policy. What a fraught moment. How much are you looking to U.S. policy to determine how far the ECB can go on its own?
Well, obviously, monetary policy always takes place in a global context. But at the same time, we're not the 13th federal district. We have our own monetary policy. We have our own set of outlooks, economic outlook, inflation outlook. And as Christine already alluded to, some of the fundamental drivers of inflation have developed quite differently in the US than in the euro area. So we have our own monetary policy to do. That monetary policy, I think, is testimony of the fact that we're increasingly confident with the disinflation process that we have been seeing and that we expect to continue. We expect it to become a little bit more bumpy also down the road because of all kinds of technical factors that I won't want to tire you with. But we are confident that the overall picture is one of continued disinflation.
So you mentioned the B word, bumps, and this is something we hear a lot. What kind of bumps would you have to see to not cut rates in June?
Well, bumps that would lead me to fundamentally change my assessment of the ongoing disinflation process. And I think the projections that we have are pretty clear, that we are moving toward reaching our target 2% inflation over the medium term in the remainder of this year, course of 2025. But there are risks surrounding such projections. But increasingly, these risks are becoming more balanced. Upside risks, I think, emanate predominantly from the labor market. And then it's not just about wages, it's about wages in combination with very slow productivity growth. That's also a major difference with the US. And the question about the capacity of firms' profit margins to absorb any increase in unit labor costs that might come from this combination of wages and productivity growth. That's the assessment we need to make. That's a risk on the upside. At the same time, we also don't want to undershoot our inflation target. We have a 2% symmetric target. We are zooming in on it, and let's make sure that we continue to do so.
So right now the market's pricing in a 25 basis point cut in June and then 2 more for the remainder of the year. You're basically on board with that if everything stays the same.
Well, I'm not uncomfortable with such market pricing, but at the same time, we don't pre-commit. We're data dependent. We go meeting by meeting. Of course, we have a picture of where we think the underlying movement is within the data. But we will have new data points, every month on inflation, every quarter on the labor market, and that will continue to inform our decisions beyond June.
Well, what would make you rethink what you have right now in terms of that path? Is it the geopolitical concerns? I'm trying to understand what would make the ECB change path, or how would they respond to, say, an oil price shock?
Yeah, well, an oil price shock obviously will lift inflation. That is absolutely true. But the question for us is the oil price shock of enough significance to trigger second-round effects? And there's an important difference here today with 2022. In 2022, all inflation items were going up, and we had the energy price shock as the consequence of Russia's unjustifiable invasion of Ukraine. Now, if we have an oil shock, it will be against the backdrop of general disinflation in all the other factors. So the likelihood of significant second-round effects, I would argue, is smaller, but it is clearly something to monitor. It's clearly something to keep in mind.
So you're willing to potentially look through it?
If it continues to be confined to energy prices only, yes. As soon as I get indication that it broadens into the consumer basket, into more traditional goods and services inflation, then the answer would turn no.
Something that people have speculated is that the ECB might be willing to also look through depreciation of the euro in response to rate cuts at a time where the Fed is not cutting, as long as there isn't an oil price shock. So let's say that there isn't an oil price shock. Would you be willing to accept parity with the euro and the dollar? All things being equal, it's fine.
Well, the exchange rate in and of itself is not a target of our policy, so I can't comment on specific levels of the exchange rate. It's one input into our overall assessment of the inflation outlook. It's clearly that a depreciating currency would lead to additionally imported inflation. At the same time, if the reason for that is tighter monetary policy in the US, higher bond yields in the US, that would also spill over to the euro area, and we would have tighter financial conditions in the euro area as a consequence of that. Which of the two effects will dominate? It remains to be seen. That's very much state contingency, so that's difficult to comment on beforehand.
A very difficult question. Some people are speculating that high rates are actually helping inflation continue because people are earning more, and then they're able to refuel that into the economy, and that low rates actually were depressive of inflation. Do you believe that?
No, I don't believe that at all. I think it runs counter to decades of empirical evidence. And if you want to see what the consequences are of running such an experiment, look at Turkey, right? I mean, that's where the experiment was brought to life. And I don't think that that's seen as a paragon of central banking success.
Dutch Central Bank President, ECB Governing Council member Klaas Knot, thank you so much for being with us. Really appreciate it. Have fun at all of the meetings and the speed dating that is the IMF and the IIF happening right now, and World Bank meetings for that matter, in Washington, D.C. Coming up, breaking jobless claims and reaction from Jonathan Pingle of UBS, who has a pretty bold call about if you do see a reacceleration of inflation, you could get a Fed that is hiking rates once again next year to potentially 6.5%. Plus, we'll go live to the IMF for interviews with the head of the South African Reserve Bank and IMF Managing Director Kristalina Georgieva. Jonathan Ferro went down there. He wasn't just avoiding us. He actually is going to be conducting those interviews right now in markets. A real sense of calm. I don't know if this is something that's going to be persistent, Annmarie, but this is definitely, basically, people don't want to do much and have much conviction about things.
Potentially calm before the storm, though.
Oh, look at that. You've been hanging out with me for a while.
Exactly.
All of those interviews from the IMF, that's later. Coming up, this is Bloomberg. 25 seconds until the latest read for U.S. economic health. We get jobless claims coming up. Michael McKee is going to break that down for you. Just to get set up for it, we do see a bit of a pause from some of the gloom and doom and disruption that we had been seeing over the past 4 days. S&P futures up just basically 0.1%. You could see that across the board. NASDAQ not outperforming, which is compelling. And that's something that we're going to talk about later. In the bond market, you could see stasis, stability after a tumultuous couple of sessions and a successful auction yesterday. Right now, we are getting the data. The data is crossing. Michael McKee, what do we see?
Well, basically the same thing that we have seen for the last several weeks. 212,000 initial jobless claims filed last week. I got to see what the revision to last week is, but that would be a 1,000 increase from the prior week if that were indeed the case. Now we've got the number coming in. I'll get that in just a second. The other thing, continuing claims go to 1,812,000. So still roughly in the same ballpark. Last week, 212 for initial claims, so no change there. We gained about 20,000 for the continuing claims. So there's no story there, except that the labor market is still tight. Philadelphia Fed Business Survey really surprises, comes in at 15.5 after 3.2 last month. Economists were expecting a drop to 2. So that is quite interesting. The prices paid index, which of course is going to get everybody's attention in this inflation-obsessed world, 23. It was 3.7 last week, so last month. So in April, 23. So prices up, labor market tight. Fed, your move.
Well, basically what you're seeing in markets is exactly what you would expect. You get a little bit of inflation fear, you get ongoing strength in the labor market, and you push it through the bond market, and you get higher yields, marginally so. This isn't a massive move, but still, it's the direction of travel. 460 once again on the 10-year. 2-year yields climbing to 496. And what we can see is, frankly, stocks are taking this in stride. Again, this is a yields rising for the right reasons that we heard from Adi Ardeni, and really not much movement at all. In the currency market, though, and this is where I think things get very interesting. Ongoing American exceptionalism is bad news for a lot of other central banks, and that's what you see ongoing. That dollar strength continues to reassert itself. The euro had been gaining. Now we are once again reverting to negative on that currency pair. Mike, I want to talk about the Philadelphia Fed business survey. How much are we looking at some of these peripheral surveys to give us a better sense of the picture? I was reading the Beige Book yesterday, and it sounded like missives from 100 different countries. How much are we getting a consistent story?
Well, the Beige Book was very interesting because it was much gloomier. I don't know if gloomier is the word, but less enthusiastic about the economy than Fed officials have been, saying that the economy is growing slightly and that prices have leveled off and people expect inflation to keep going down, which doesn't seem to be the reality that we're seeing. Now, the regional Fed numbers and surveys, they're regional. They don't necessarily tell us a lot about the whole country. And we see the ISM number come in once a month that can frequently undercut all of that. But with the focus on inflation and on whether the economy is coming back. People are looking to see what the strength was in the Philadelphia and New Jersey area and what the inflation situation is, and it's all clues that kind of go together. But I don't think you're going to see big market moves on this. Wait till next week when we get to PCE numbers.
A lot of people are going to be looking to that. Michael McKee, stay close, please. Right now, I want to bring in someone who we've been talking about all week. Jonathan Pingle of UBS. He came out with a call that was nuanced, and I think that that's the important way of putting it, and I want to start there. You talk about how your base case is 2 rate cuts, but you made headlines by talking about the possibility for the Fed to raise rates to 6.5% next year. Put those two stories together. Please explain.
Well, I mean, the stories are, I hate to admit it, they are somewhat born out of our own forecast errors, right? So I think there's an element of needing to be humble here, but, I mean, the basic fact is growth has surprised persistently, for the last year or more, essentially. And, when we think about the central bank, we're all focused on inflation. They're very focused on inflation. But in the backdrop, they have this very strong labor market, strong headline numbers, retail sales. And at some point, if that is really what's preventing them from achieving their inflation target or making further progress, at some point they may need to push back on that. And pushing back on that would imply something, I think, a little bit more than just higher for longer, where they maintain the same level of rates and hope that that slows growth and they make this grinding progress down towards 2%. Because if the economy is going to remain sufficiently strong, I mean, non-farm payroll employment, 303,000, extraordinary number. But even if it's still running at this 244 average pace, eventually the unemployment rate is going to start moving lower. And that seems pretty inconsistent with 2% inflation. At some point, the central bank may think they need to do something about it.
Are you basically saying that if inflation doesn't come under control, the Fed's going to have to break something?
This isn't even about breaking something. I mean, this is like going from 244 to something closer to trend. I mean, it's really an extraordinary pace of growth. It's persisted for a while, and they might think that they need to break something in order to solve this sort of, I've been calling it sort of the last half-mile problem, like if they're stuck at 2.5. But I think if growth is going to be 3% GDP growth and 250 on payrolls, I mean, they're just, I think, they're going to end up coming to the realization that that is not going to allow them to achieve price stability.
We heard from Michelle Bowman last night saying she thinks policy is restrictive, but maybe time will tell if it's restrictive enough. When you see these kind of numbers in this kind of market and you have a probability, even though it's small, you are putting in a probability of a hike. Do you think the Fed is restrictive?
Well, I do think the Fed is restrictive, but I have to say I've been thinking the Fed is restrictive. And at the same time, I'm still not seeing the kind of slowdown I would have expected. I mean, you do see some evidence of restrictiveness. I mean, equipment investment, a lot of different types of business fixed investment have been pretty weak. And that looks like it's the effect of higher interest rates restraining that activity. But overall, when you're watching consumption growth at the pace we've had it, it's very difficult to think that, well, you know what, is the neutral rate really the 0.6 in the SEP? So we've started thinking about a short-run neutral rate. But I will say it's hard to identify these things in models. It's hard to come up with a point estimate. So the Fed and we are really feeling our way forward. And I think as we feel our way forward, if growth is just going to remain super strong, at some point they might realize they need higher rates to kind of, tame the economic conditions that would engineer a path to 2%.
But back to your base case, you did push back your timing, though, of that first cut to September. A lot of people are saying September, right?
Yeah, no, we did. I'm only laughing because we got the CPI, and I actually published the rate call change faster than we published our CPI write-up.
But why are you even having 2 cuts if this is what you're talking about?
Well, we have 2 cuts because we do think the economy is going to slow. We're looking at an expansion where the sources of growth have been relatively narrow. So we look at 2023, and we think there was a big impetus from fiscal policy. And we think we're seeing that fade, both in the pace of manufacturing plant construction that was supported by the CHIPS Act and the IRA, as well as sort of what we're seeing in public infrastructure investment, for example. And we're also seeing a fair amount of hardship in households. And we think that that is the recipe for a slower second half. But we've been thinking that that's a recipe for slowing. And the upper 20% of the income distribution remains awash in cash, liquid assets, and high levels of wealth.
So I think that Annmarie was going to September and this question around politics.
Of course.
Oh, yeah.
Because there's
We're in Washington.
here we are. People are saying, can we actually get a September rate cut given the fact that we have one of the more contentious elections that we've had in a very long time? How do you push back and say, okay, if the economic fundamentals determine that this is the way to go, the Fed will just do it? Is that really realistic based on the climate we're in?
I think it is. I think it does put the onus on their communications to explain why it's unfolding. But when we look back at history, we've sort of analyzed the September moves. I mean, we can debate whether or not the start of a cycle is different than an ongoing cycle, but they do move in plenty of Septembers within 3 months of a presidential election. I just think their communications have been such that they've laid out this plan. They've been telling everybody that I don't think it would be particularly surprising if the data started to go their way. They're communicating it. I think November would be a challenge, 2 days after the presidential election. I mean, could you imagine waiting and then doing that? So I do think the odds of November should be pretty low to start an easing cycle, but I think September is probably okay.
Jonathan Finkel of UBS, thank you. That was really interesting, especially given the fact that people are starting to rumble about the potential for a rate hike at some point. Right now in markets, all is calm. You are seeing a bit of a reset in bond markets in the heels of some of that data, with yields now solidly up a whole 2 basis points, 460.80. You are seeing that not necessarily affect badly on stocks, still up 0.2%. I don't want to delay. Let's head over to the IMF. Jonathan Ferro did get down there. He is currently alongside the head of the South African Reserve Bank. John.
Hey, Bramo, thank you. I was just going to say there's a man next to me who probably doesn't want the Federal Reserve to hike again anytime soon. I can catch up with my old friend, Governor Lesetja Kganyago. Governor, thank you very much for being with us at the IMF.
Good to be here.
Inflation comes down to 5.3. The market, the general estimate, the consensus estimate was 5.4. First question, you're cutting interest rates off the back of a downside surprise like that?
Well, we had 5.3 as our forecast as a central bank. And I guess that the fact that the markets get excited that the print that surprised them by 0.1 just tells you the extent of the uncertainty that we are in. We have not quite seen a discernible trend because we had peaked at 7.8% in 2022 and we were coming down nicely. We went all the way to 4.7 and then we started to go up again and it rose all the way to 5.6 and we are now at 5.3. There isn't a discernible trend, but a look at the components of inflation makes for an interesting read. Food prices have continued their downward trend. They might be reaching the bottom. It's too early to tell because we do not know the effects of El Nino. Core has also now come down to 4.9%, and we hope that it sustains that momentum. And so too early to tell what a discernible trend would be.
Speaking of upside surprises or small surprises and big reactions, saw a similar thing in the United States last week, the other way around. You had a downside surprise. US CPI came in a little bit hotter than expected, and all of a sudden, the markets, big moves in rates, dollar a whole lot stronger, and big questions about central banks abroad and the consequences for them. Could you give us a bit of colour on that, Governor? What are the consequences for you? How independent is your policy from what the Federal Reserve may or may not do in the future?
Well, we watch the Fed, we don't follow the Fed. The decisions of the Fed reflect a key institution's take on the U.S. economy, which is the largest economy in the world. We are a small, open economy. The actions of the Fed have an impact on global financial conditions, and global financial conditions have got implications for the direction of capital flows, and thus a realignment of exchange rates. And actually, at our previous, many of our meetings in the past, we had highlighted that the tight global financial conditions have got implications for the exchange rate, and by extension could lead to an impact on domestic prices. There are a range of other factors, but we do not follow the Fed. We watch it. We started tightening policy a good 12 months before the Fed started doing it. We started in 2021. The Fed only started in 2022. But the actions of the Fed have got huge implications for global financial markets.
Big implications for the FX channel as well. The rand's actually been pretty stable against the backdrop of a much, much stronger dollar. Why do you think that is?
Difficult to tell. This currency gets everywhere. I think that there had been a lot of negative news that had gone into the rand. There's been a lot of uncertainty, and when I talk to market players in South Africa, I said there is an uncertainty about the elections, and I said that more than half of the world population is voting this year. What makes the South African elections so special? I said, well, the one thing is that for the past 30 years, all that we knew was one governing party, and now there is a possibility that we might end up in a coalition. And if you end up in a coalition, who do we end up with a coalition with? And this is a lot of uncertainty, which then says that the elections behind us, and now everybody knows exactly what the political outlook is. And if the concerns had been about that, that means that it takes away massive uncertainty. For us as a central bank, we have just been looking at the data and whether we are picking up any discernible trend from the data.
You mentioned the politics. I didn't. So let's talk about the politics. You've got an interesting calendar ahead of you. I think the end of May is the election, and your policy decision is a day after. Is that right?
Yeah, that's correct.
So the conversation we're having in the United States, I'll give you some colour on that, and I'll tell you what it sounds like, and I'm sure you're familiar with it. There is this belief that the Federal Reserve won't really do anything around the election, that because they don't want to get political, they'll avoid politics, but at the same time, they're considering politics to avoid being political. How does that work for you?
Well, we are very clear. This is an interesting thing. We release a calendar of our policy meetings a year in advance. We didn't know when the president will pronounce an election, and he announces an election bang in the middle of our policy meeting. We have got to look through that, and there is a reason why we are focused just on data, and we are taken away from the political cycle so that we can actually make technical decisions and not be affected by the political cycle. But there is also something. The president decided to insulate the Reserve Bank from the political cycle by taking a decision about the renewal of my term and those of my deputy governors and the term of the Commissioner of the South African Revenue Services. Make those decisions ahead of the elections so that it does not get affected by the political cycle. So we make our decisions based on data, based on our outlook for both growth and for inflation.
So congratulations on a second term. I do have a final question, though. The conversation with the Treasury about a new inflation target, where are we with that? And do you expect to come to an agreement sometime soon?
There should be an agreement, but I don't expect anything to happen before the elections. This is not like our policy calibration decision. This is about the framework and making changes on the framework. The Treasury had commissioned a macroeconomic review, and as part of the budget documents, they did release a document on the macro review, including the consideration of the lowering of the inflation target. That is a conversation that we would continue. The manner in which the process works in South Africa is that the minister makes the announcement about a target, but there is a process towards that announcement, and that process is a technical process between the Reserve Bank and the National Treasury.
Governor, you've been very kind to give us so much time. Thank you very much for being with us here in Washington, D.C.
It's always a pleasure talking to you, Jonathan.
Thank you, sir. Lisa, I'm going to throw it back to you at our headquarters here in Washington.
Great work. Thank you so much, John. A great conversation, especially given the fact that people all are watching the Fed, but they are their own entities. And about politics, well, we're data dependent. Right now in markets, we are data dependent as well, and we are seeing the data coming in a bit better than expected. The read through to markets is basically very muted on futures. You see S&P futures up about 0.1%, but pretty muted as well on bond yields, up just marginally 1 basis point. It's basically pretty much a stasis after a whole host of dramatic couple of days. Coming up, don't miss this, IMF Managing Director Kristalina Georgieva. Guess what? We got more data out of the United States, and guess what? It was better than expected, with jobless claims having the right kind of downside surprise, as John would say. You're coming in below expectations, and what you can see in markets is basically that what's good news for stocks is bad news from bonds once again, but on the margins, not a huge market mover or shaker. What you are seeing is S&P futures up, though, 0.2%, and we've been talking about this. The fact that we've got the biggest downside surprise or the biggest downward streak in equities, the fact that it wasn't that much shows you where we've been. 50.71 on the S&P, a bit of a dollar strength. You could see that with the euro down just a touch, 106.64, with that whole U.S. exceptionalism story. Oil, interestingly, down just about 0.16%. And basically this question of at what point will geopolitics rear its head once again in the crude space. Under surveillance this morning, the challenges for global growth. Earlier, we spoke with John Lipsky, formerly of the IMF, about the rising risks to free trade and how emerging markets can catch up.
The U.S. is, as the IMF World Economic Outlook pointed out, is performing in an exceptional way. The question is that sustainable or temporary? Is it produce the as we said, you said just a few minutes ago, the IMF called it overheating. But that's not so obvious in the data. And the IMF's own figures point to an easing in growth in the U.S. next year. So it seems to me that it'll be more important to look at the underlying causes of stronger growth in the U.S. Why is growth in the advanced economies is weak, and in the emerging and developing economies falling far behind? As the IMF pointed out, only the U.S. has got GDP output at this time above what had been expected before the pandemic. Everywhere else is behind, and for the poorest countries, they're the furthest behind. In other words, scarring has been important, and more important for less developed countries. This was going to require not just rhetoric, but some deep thought and action of how to boost productivity and growth in these countries. Recent developments have shown is the importance of multilateral institutions as a place for dialogue. Obviously, we're going through a very difficult time. I think back to my period at the IMF during the global financial crisis. There was a real sense if we don't hang together, we will all hang separately. And you didn't have a sense of great power conflict in trying to figure out how to move forward. I think what we're seeing now is an environment of conflict, of still uncertain degree, that the global economy is not performing well. As the IMF points out, global growth is slowing. I think that it's going to take, obviously, return to effective multilateral action, open markets, open financial markets, open trade markets to get global growth back growing again.
It was a great conversation at a time where we've been talking a lot about how U.S. policy, in particular Federal Reserve policy, affects the rest of the world. And we talk about exceptionalism. Michael McKee is still with us. And I do want to go to you on this idea of the rest of the world is watching the Federal Reserve and thinking a lot about it. They might not be directing policy as a result of it, or they won't say that they are. How much is the Fed watching the rest of the world?
They're watching it in terms of feedback loops. If something happens overseas, say the European economy slows down significantly and then trade with Europe slows down. And so that becomes a problem for the United States in terms of our exports. But the world looks at the Fed because the Fed sets the world's interest rates, basically the baseline for all of the developed countries.
What did you make of Treasury Secretary Janet Yellen saying that she's watching the dollar strength?
That's a little concerning. Those of us who were around in the Lloyd Bentsen, Bob Rubin days remember what happened when Treasury secretaries start musing about the dollar, which is why they've all stuck to this line about a strong dollar is in the U.S. national interest without ever defining what a strong dollar is. The problem that a lot of people see, and I've been talking to a lot of people, obviously, in Washington because of the IMF and World Bank meetings from other countries, is the big budget deficits in the U.S. are going to cause markets to demand a higher premium, which pushes U.S. interest rates up irrespective of the Fed, and that means the dollar gets stronger. And more people will want to invest in the U.S. because rates are higher. So we get all this dollar strength. The rest of the world gets left behind, which is why you'll hear a lot this week, I think, from the IMF and from a lot of the investors who are in town about how the U.S. needs to address its budget deficit.
Well,
they had a serious concern in the report. It was a rare, almost criticism of the U.S., saying the U.S. has exceptionalism because of this fiscal policy. How difficult is that going to be this week for, John put it really well, a number of complaints lining up, not behind so much Chair Powell's door, but Secretary Yellen's door?
Yeah, I don't know that it has a lot of influence. The United States is the largest shareholder in the IMF, but doesn't particularly care what the IMF thinks about its policies. So they will go on and do whatever they can. Now, obviously, the presidential candidates and congressmen are paying lip service to the idea of reducing the deficit. But will they really? That's going to be the issue.
And
Not
how
an
they
election
do.
year.
Yeah, and how they do is going to be really key. Coming up tomorrow, we get to have a continuation of these conversations, in particular having to do with trade. U.S. Trade Representative Catherine Tai is going to be joining us, Banco Santander Chair Anna Boyton, and IMF First Deputy Managing Director Geeta Gopinath all joining us to talk about the myriad crosswinds. From New York, this is Bloomberg.